Hey everyone, Douglas here, and welcome back to the MMT Macro Trader live stream. I've got Bijou on the line, as always.
Hello.
Welcome back to the number one MMT live stream in the nation. And I'll tell you what, not only the number one MMT live stream in the nation, but the only place on all of YouTube, on all the internet, where you're going to get this sort of MMT information, MMT analysis. Yeah, the only place that you're going to get this analysis. Nowhere else can you get analysis like this, but here.
Especially not from any surfer dudes.
No, yeah. No one else. All jokes aside, welcome everyone. Yeah. Welcome.
Yeah, MMT Macro Trader. Welcome everyone. Bring on your questions today. It'll be good fun to go through them. Anything you got. We're also this is the only channel where you can find high quality, high class MMT poetry.
No, that is true. Okay, that is absolutely true.
Yeah, without too many F-bombs. So stay tuned. You never know what'll happen.
Speaking about not knowing what's going to happen, the chat doesn't know what's going to happen. You and I know what's going to happen. Applied MMT podcast. Adam just hinted at what's about to happen. We might have a special guest on momentarily, someone that I've been chatting with a little bit on the Twitter DMs, a bit of a banking expert himself. Hopefully we can get Ryan on from Applied MMT podcast.
Ryan. I need a superhero name for Ryan. Is it the equities guy or something snazzier? I'm looking for a good supervillain name for Mr. Debt Ceiling, and now one for Ryan.
Debt Ceiling has been defeated, though. I mean, that is the debt.
Arkham Asylum. Yeah, that's what I noted at the beginning.
The Debt Ceiling's been defeated, but it is being resurrected. He is resurrected as the TGA. The TGA risk, which is one of the things we're going to talk about tonight. By the way, if everyone, if you watch these after the fact,
TGA terrorist.
Just to kind of set up the goal for tonight, we are going to talk a little bit about TGA. That has been there's been all the fear that has been on Twitter for markets this week. We'll talk TGA. I also just today ran across some really interesting data that we can dive into. I tweeted about it just a little while ago, and I've got Ryan coming in, so I'm going to go ahead and admit him. Give me 1 second. And now all of a sudden, Ryan, welcome, man. All of a sudden the boxes and everything are going crazy.
Oh, hi, Ryan. Yeah, he's up there.
He is up there. Anyway, Ryan is now in. That's why Bijou is no longer showing. But Ryan, when you can hear us, you get your mic figured out, go ahead. And we cannot hear you, Ryan. Maybe select the different mic input, but we do have Ryan joining us, so he's just hopping on in to join us. Anyway, TGA tonight, TGA account. We have some data that I want to look at that I think continues to support the case that higher rates push inflation and kind of. Brian, I think I just heard you kind of finish that. What is TGA? Very good question. The TGA is the Treasury General Account. So because of actually, Ryan, I can't hear you, but I thought I heard you come in. The TGA is the Treasury General Account, and the Treasury General Account is kind of the checking account for the Treasury to spend out of. And during the run up to the debt ceiling, we had this situation where it almost drew down to zero. Actually, I can just go ahead and pull up that screen. Yeah, here's the TGA account. It pushed almost to zero. So what's going to happen is the Treasury is now going to rebuild this. They're going to go ahead and rebuild the Treasury General account. Yeah, they're going to rebuild it.
Yeah, blocks of fiat bullion.
Yes. Yes.
So we need those blocks.
And once Ryan gets on here too, he's going to be able to essentially, let us give us the whole run through of exactly how it's going to happen in probably more detail than I know that I can. But how it's going to get accomplished is normally what happens is the Treasury spends. I'm sorry, when the Treasury needs to fill its TGA, it does so by selling off the bonds, right? So or the Treasuries, I guess. So they're going to sell those Treasuries off. But normally, in just kind of the normal course of action, the reserves are also being created at the same time because the spending is happening. Right? The spending flow coming out of the Treasury is happening at the exact same time that the bond issuance is happening. So there's never a major.
No. Is this collusion? Is this cooperation?
It's almost
Treasury and the Rothschilds at the Fed.
It's it's almost like
It's almost like they're part of government.
It's almost like it's exactly. So the concern is. Oh, Ryan, we can finally hear you, my man.
Hey. Oh,
there he is.
You can hear me?
Yeah, we can hear you. Welcome.
Here. Yeah.
All right, let's go.
Let's go, man. Nice.
Okay.
Now, real quick, I'm gonna pop a question into chat, guys. Sorry on the live stream side of things. Well, you guys are now gonna see. Do you need me to block out your name when I share your little photo block there?
No.
Okay. I didn't. Just wanted to make sure.
How you guys doing?
You didn't want to get
we're doing good.
Good, yeah.
As long as you don't mind your name going on the internet there. So yeah.
Let's see. Yeah, okay. Guys, I'm sorry about all the interruption here on the live stream. One, tons of people joining too. Make sure you hit the like button, all that good stuff. Get subscribed. I appreciate that. And yeah, like I said, Ryan is joining. I promise in just a second, you're going to see all three of us up here. There you go. All right. We're good. Ryan, how's it going, my man?
Yep. Good. Excited to be honest with you guys.
Yeah, excited to have you here.
Excellent.
I don't know where you were setting up.
What time is it? What time is it for you?
Bijou, can you hear Ryan?
Yeah. He's asking what time is it for you?
For you, Bijou. Yeah.
For
me, it's lunchtime. So yeah. I have to quit lunch because I'm always in a rush to get onto the live stream. So I'm running on like tea leaves.
Got it.
I think it's 8 p.m. or 9 p.m. in Michigan.
Where I'm at, 8 p.m. Yep.
Yep.
Anyway, Ryan, could you hear my discussion on the TGA as you were getting your mic figured out? Could you hear my assessment there?
Yeah. Yes. So I actually haven't looked at the actual numbers. Like has the large TGA cash build started?
It's starting. Yes, I believe there was something like 50 billion. I know they want to get it up to some outrageous number. Once again, and
I saw they issued a press release. I guess they're guiding for like a balance of around 450 billion by the end of June.
Correct.
Which so like I was texting Adam about this, and I started to do a little thread on Twitter about this, and you guys correct me if I'm wrong, but I just thinking through. I mean, there's all this like fear mongering and stuff going on. All these articles coming, all these Wall Street analysts saying, "Oh my gosh, there's massive reserve drain. It's gonna suck out all the liquidity, and it's gonna be horrible for financial markets and blah blah blah." And I was thinking about it, and I think it's actually the exact opposite of that.
Yeah.
And the reason I think it's the opposite, so we kind of talked about this a little bit with Nick from ANG Traders.
Yeah.
Who we just posted I think Adam just posted the first half of that podcast yesterday, and he said that he had run some numbers on and had reason to believe that when the Treasury issues a lot of securities, that tends to be positive for financial markets as opposed to being negative the way that's people are freaking out about and stuff. And we were and I was like, do you know why that is? Like what the channel is? He's like, not exactly sure. Could be just like the collateral channel or income, interest income or what have you. I was like, okay, that's interesting. And then so I'm reading these articles and thinking about, and it seems like most of these analysts only have half the story right? They say that the that the reserves are going to get drained from the commercial banking system, and that's true. But what they're missing, and this is the whole thing. This is what Warren Moser has been talking about for decades. This is what Stephanie Kelton wrote about, over 2 decades ago in her kind of seminal paper when she was still, I think, like a PhD student, was that the Fed actually, if you're gonna increase if the reserves are just going to get drained out of commercial bank accounts, that would cause the federal funds rate to spike.
Say that one more time. Repeat that. Say that again.
If the Treasury issues securities that drain the reserves out of the commercial banking system, right? That's what it does, right? The reserves get debited out of commercial bank accounts and credit to the Treasury's general account. So there's fewer. So that actually causes, like all things being equal in a vacuum, right? Let's say demand for reserves are the same. That's going to cause the federal funds rate, the policy rate, to spike because there's now a shortage of reserves. Of reserves. Exactly. So the Fed, it has a policy rate. It coordinates with the banking system to add or remove reserves, to get it within the range bound that they've set forth, and as per the FOMC policy. So what that means is that the Fed has to add reserves in order to meet its policy rate. So even if the Treasury is issuing securities and that's draining reserves, the Fed has to be adding additional reserves in order to keep the rate stable, and it can do so by purchasing government securities, or it can also just make loans to commercial banks. Right? It basically can advance the reserves to the commercial banks to ensure that there are enough, to meet their demand in accordance to their policy rate. So that's why I think this is actually very stimulative, because the Fed is going and it's creating reserves. It's creating credit in order to accommodate the Treasury's, bond or bill issuance. And so that's where they're missing. That's the whole thing of these, with Warren Moser talking about, these accounts having to balance and stuff. They have it right. It is draining reserves. What they don't understand is that the Fed adds the reserves that are being drained
in the first place.
In the first place, right? And it has to. If it didn't do that, it wouldn't be able to hit its policy rate. And so, and the only reason that they're doing this, right, is because the only reason that the Treasury is, raising this cash, quote unquote, right now is because it's going to spend it. So in a way, like the Fed is almost like creating space in the commercial, on commercial bank balance sheets for this spending that's going to come from the Treasury, right? So let's just say, the Fed advances, $50 billion to the commercial banking system. It basically credits their reserve accounts and books an asset on it, whatever kind of asset on its balance sheet. Okay, that's basically like a loan from the Fed to the commercial banks, and then the payment comes from the Treasuries, and all of a sudden that cash can be used to pay that loan back. So that's that's kind of the process that people are missing, and so I think that sort of when you have this kind of bump in credit creation, in liquidity injections, in anticipated spending, that stimulates the financial markets. Is what I sort of think. Like think back to March and April 2020, right? We said that we were going to spend $2 trillion on for the CARES Act. I think in April 2020 there was like $1 trillion or something that had to get raised into the TGA. I didn't have time. I was hoping to look back at what the actual balances looked like in the TGA at the time. I don't think the TGA had the cash on hand necessarily. It had to go out and raise that cash, and the financial markets went crazy in April 2020.
Yep.
Right. So it's like there is precedent for this type of a thing where you have this very, very extreme kind of scenario of like, yeah, we need to raise this cash really quickly. It's how are we going to do that? Well, we're going to do it by having the Fed add a bunch of reserves into the commercial banks, and those are going to be what are drained out. So that's why I think like we've had this sort of pretty substantial advance in financial markets over the last week or so. I mean, credit spreads have come down. Stock markets sort of roared ahead, and particularly like bank stocks have performed very well, and other kind of cyclicals. So that to me sort of validates this thinking of like, no, these guys are completely wrong. Like they're right that there's a reserve drain, but they're wrong as to the actual impact, because the Fed by definition or by policy, I guess, has to inject reserves into commercial banks. So the Fed, I don't think the balance, like the Fed's weekly report, the H41 or whatever, has come out for this week, but I'm very curious to see what that actually looks
when it finally prints. Yeah, we will find out. Let me a couple
to take in.
A couple thoughts here.
Some way they have to put the reserves back in, right? So.
I think the argument from the bear side though is that normally there is kind of an offsetting reserve build before the drain, and I think what they're saying is the drain's going to be so massive because the TGA build needs to occur that I mean there's no effective offsetting spending ahead of time. In this one instance, but I think as Ken PDX pointed out, we're the banking system is still chock full of reserves. I mean, they're not. It's my understanding too. Banks generally don't like to have reserves on their balance sheet any more than they need to be regulatory or in regulatory compliance. Am I right about that? I mean, this is where really I don't have an expertise in banking, but that's my assumption.
The lending is not reserve constrained.
I understand that. I understand that.
Capital adequacy requirements.
Yeah,
so that's not going to be a stopper.
Yeah, I understand. I understand
that
that
used to be the case more so when they didn't receive any interest on reserves.
Okay, so now they're okay. Yep, that's a good point. That's a good point. They're a little bit happier now because they receive the interest on the reserves that are in there. Prior, it actually was. When did that start? That started after.
Oh wait,
that did start after 2008. Okay. Maybe I just again the we'll call it the street by street, corner by corner plumbing of the inner workings of the banking system and the reserve system as it connects from the Treasury to the central banks to the individual banks to further banks further on down the line. It's unnecessarily complicated and not exactly something I'm an expert on. And so maybe on a very short run, I could see a few banks being a little flat-footed in being able to accommodate the moves that are necessary. But the one thing I guess, and again, the argument that I think I'm understanding is a lot of the Twitter world calls reserves liquidity. I get why they call that liquidity. I don't think it's the best name to call reserves.
Settlement balances.
Yeah, I don't think. Yeah, exactly. Settlement balance is probably a better name. I just don't see how that directly correlates to financial asset prices unless a few banks possibly are slightly overweighted to risk assets and they have to sell some of those risk assets to meet regulatory to meet regulation. That's the only way that can ever. That's the only transmission route into forced selling of risk assets. Correct? Right?
I'll let Ryan think on that for a minute.
Yeah.
But I'll just say that I think Ryan's basic fundamental story is correct. That the panic and fear is just misplaced. Right. That's the first thing. But then how the way that the TGA is going to be built turns into fiscal in some way is the question, I guess. But yeah, Ryan, what were you thinking? What were your thoughts on that?
Yeah, I would just say, like, in terms of financial markets and stuff, there's sort of this. You think about it in terms of like a hierarchy of like moneyness almost and asset quality and stuff. So if there is a so-called shortage of high quality liquid assets or settlement balances that would be used, because there's uncertainty. If you have something that's not guaranteed to clear at par value and there's a shortage of such instruments, then the first things that you're going to try to sell are the lowest quality ones, so that so that you can get as much as your current market value as you can. So I do think like it's sort of like the argument about, I do think there's something to be said. In 2022 we had massive tax reserve drains, and I think that caused that that had something to do with the stress we saw in financial markets.
Yep.
So I do think that at some sort of that those factors matter. The other thing I would say, because I've been thinking about this the last few days, and it's true that banks have a lot of reserves, but at the same time, the Fed adds or removes reserves according to its policy rate. So again, if the if you had a massive one-off sort of reserve drain, there's only enough reserves to meet the bank's demand for reserves at the rate that the Fed is setting. And so if all of a sudden, snap, you get a bunch of them disappear, well, then the price is going to go up, regardless of the ample reserves regime that we're in. So I really do think that the bottom line is that, like, the Fed accommodates the banks with the reserves that are needed to meet its policy rate. And to the extent that they could screw something up, there's always that risk, but that seems like very, very, very low. There's almost never any hiccups, right? There's always talk about this random 2019 kind of overnight repo hiccup that happened. But, that was more so around, that was related to an unexpectedly large tax drain from corporate tax payments. So if
did that happen? Was that the June corporate tax payment that caused that?
No, September.
Okay.
15.
Yep.
And so that tax drain coincided with settlement date of some new issuances from the that were issued by the Treasury. So it just kind of caused this. There's all of a sudden just like a shortage of settlement balances, and so the rate spiked overnight. If somebody were to say to me, this June 15 tax drain,
that's what I'm going to say. Yeah. Okay, good. I'm glad you're going there.
Right. If someone were to say to me, hey, it's going to be a lot more severe than anyone's expecting, and has a legitimate reason as to why, then sure, I could see that causing some stress, at least temporary stress. But I don't really see this a case that can be made. The Fed is going to create as much Federal Reserve credit as it needs to accommodate the banks, according to its policies. So I don't really see that as an issue. And if anything, the fact that this is happening, it means that there's more credit being created, and that sort of stimulates the economy or the financial markets in and of themselves. And something I've been kind of toying with, and I'm wondering if this shows at all in some of your work, Douglas, is so the Fed creates credit. It lends reserves to the commercial banks in anticipation of the Treasury spending, right? Because those reserves that it lends into creation essentially end up in the Treasury's general account. So I wonder, there's always this talk about the stock market is a great predictor of both economic booms and busts. And the thinking is, these are prudent investors, and they're anticipating a turn or whatnot. They're they're talking to management, blah blah blah. And part of me wonders if it's actually more mechanical than that, and that it's basically the Fed is creating additional reserves in coordination with the Treasury, because the Treasury is about to spend a bunch of money, and it needs the reserves in its account. So the Fed has to create the reserves first, and that creation activity actually stimulates the financial markets, and then you get this spending done by the government that actually stimulates the economy. So I've been kind of wondering for a while now if that kind of relationship is actually more mechanical than anything else.
The price of the S&P 500 is a mechanically determined price sort of guy. That's been my argument for quite some time. A couple months ago, Bijou and I kind of went over this. I did some research where I divided out the I think it was ultimately the debt held by the public. Essentially the national debt held by the public, divided that out by divided the S&P market cap by that. And you effectively get a straight line except for the .com boom, right? Which would be the major acceleration of private debt during that time period, right? So a true kind of bubble scenario. Otherwise, over 40 or 50 years of that data, if you take out the national debt effectively, right, the private sector savings part, right, you get just a straight line in the S&P. So I think the price of the S&P goes up because the government spends, and any fluctuation from that is just the normal dynamics of markets occurring, no matter what, right? The normal, the kind of the normal dynamics of a complex system occurring that you would see across any asset, no matter what it is, as long as it's being traded. So, obviously part of the price is being determined by, actors, agents that are trading, that are trying to determine what the correct price is. But the trend over time is because the government prints money, and that's what becomes private sector savings, and people have to save, and there's a tax advantage to do it in stocks. So that's always been my thesis. In terms of
the other thing, sorry.
Yeah, the one thing though, specifically in terms of reserves, I haven't found any correlation directly with reserves, in any change in reserves or any acceleration or anything like that. And in fact, some of the models I will put reserves in, but I don't actually think they're it's causing it. Maybe it is, right? It's always difficult because the dynamic, the kind of the causal link could be, so nonlinear that my eye test can't see it. But all the tests I've done, I haven't seen too much connection between reserves specifically and stocks at this point. But
well, is there any subtlety in how the Fed goes about filling up the reserves? Okay, let's just hypothesize a little bit, right? Suppose Ryan's right, and the TGA build does cause reserves in the system to get near critical, say, and so what Ken PDX in the chat said, that they're stock full of reserves at the moment. Let's say theoretically that drain does happen. Then they've got options. They've got multiple ways of putting reserves back into the interbank clearing payment system, right? Correct settlement balances. But as we're saying, as MMT is, that neither affects or changes their ability to make loans. But there might be an issue with how they do that. Is that the case? I mean, I don't know. I'm just guessing. There's many. I think there's several ways they could put reserves back into the system. As I agree with Ryan, they need to do because of the institutional arrangements and policy. Otherwise, the interbank interest rate would shoot up. So if they want to stick to the rate target, they have to put the reserves back in somehow. But that's going into settlement balances. It's not going out into the real economy. So I was wanting to ask you guys how it gets back out into the real economy in terms of credit for the bank customers.
Well, anyway. I think the first thing is that it goes out into the real economy when the Treasury makes payments.
Yep.
Right.
Yep.
Right. Exactly. So that's the whole reason they want to build up their accounts, right? So they can then allow themselves permission to make the payments. Right.
Exactly. Yeah.
And that allows banks to lend because you're creating credit-worthy borrowers. So yeah, it's doing fiscal really. Right.
Right.
Gotcha.
It's in anticipation, and Stephanie Kelton has this great line in her in this paper where she's basically like, bonds then are used to coordinate deficit spending, draining what would otherwise become excess reserves. So again, it's a coordination thing, and if the Treasury needs to spend a lot of money because of its institutional arrangement, to steal your term, Bijou, because of its institutional arrangement, it has to issue a ton of bills first. And in order for it to do that and have rates not spike, requires the Fed to essentially credit those reserves.
Yeah.
And so that's like the whole. So that's MMT. That's what Moser's been talking about for decades now, and this is like the crux of the whole thing.
Yeah.
And so.
Yep, it's going to be a fiscal dominance situation again. So it's going to be a stimulatory in at least two ways, right? There's fiscal coming from government, and there's also then more credit-worthy borrowers for commercial banks. So, yeah, like you say, originally, like your very first point, it's like this is not a bad thing at all.
I want to back up and just kind of think through something real quick. I want to make sure I'm not convinced by the bear argument here, because even then I don't have the chart pulled up, but I do vaguely remember the September.
Wait a minute, I think I'm with Ryan that it's bull.
That it's bull. It's all bull.
I don't know. The bear argument is what the others are making.
No, that's what I'm saying. I want to give the bear argument a fair shake. That's what I'm saying. I want to give the bear argument a full fair shake.
Gotcha. Yes. Okay,
but Ryan, going back to, our market's mechanically determined for the most part, right? We'll call it on trend. Okay, are they mechanically determined? Clearly, we would all be in agreement, without a doubt, that any plumbing issues have nothing to do with the real economy, right? If there are plumbing issues, it's going to be a week or two to worst case scenario, but it's not necessarily going to interrupt lending, right? Like lending will still happen, economic activity will still happen. It is just that mesoeconomic touch point between markets, the financial sector, banking and the Fed and central banks and the Treasury, that one spot where they all touch, it would only be the plumbing issue that happens at that point. And so any selling that we were to see, let's just say we, 2019 when this occurred, when we had some plumbing issue occur, when the price changes in the S&P or in the markets because of that, it has nothing to do with market actors and market agents saying, "Oh God, we're going to have a slowdown in economic activity." It's literally our hands are forced. We need to sell assets right now, right? I mean, that would be what would cause a sell-off. Am I right in that? Is that a fair way of putting it? If you're kind of tracking where I'm going, yeah. Okay.
Yeah, I think that's right. I would also just add though that, and I think I get a little bit of what you're getting at, is that like securities markets are not the same as the real economy. Mm-hmm. And I think that's something that a lot of people, particularly people in finance, need to do a better job of grasping. There's all this stuff, all this talk about, collateral shortages and all this other nonsense and whatnot. It's like, well, yeah, that matters for securities markets. That matters for hedge funds that have leverage basis trades on. But that doesn't, and to the extent, sure, maybe like at the very margins, it might tweak some things, but that has nothing to do with whether a farmer can get a loan in Nebraska or something, right? It's just not there. And in some ways, like the institutional structure we have, where we've combined, we've allowed commercial banks and investment banks to work to operate under the same parent company, I think has really confused a lot of people, like a whole generation.
Yes, yeah, that's a good way of putting it. Yep.
Yeah, absolutely.
It's confusing to me still. I mean, you still, and it's hard to have this discussion because there are so many, there's multiple people operating under the exact same kind of umbrella name. And it gets confusing when you piece it all together. You really have to slow down and think it through. Yeah, that was well put, man. The next point then. Let me do this. We got 17 people watching right now, at least that I can tell. The number keeps growing, but I only have 11 likes. Hit that like button, guys. This is probably one of the coolest discussions we've had in quite some time. Ryan, I know we've been having some discussions. I know you're really well versed in the banking system, so this is cool. Feel free to stay as long as you can, as long as you want. I've got a few other questions. But hit that like button, everyone that's here. Hopefully you're all learning a lot. I know I am. Also, real quick, Ryan and Adam, they run the MMT. Hold on a second. I'm pulling it up. Give me a second. I have too many screens going on here. They run the Applied MMT podcast. I'm going to go ahead and pull that up. I think they can still hear you talk right now while the screen is up. I know that was broke at one point. Applied MMT podcast, appliedmmt.com. All the links are there to watch. I watch it or listen to it on YouTube. Great podcast. Great recent interview with Nick Gomez of ANG Traders. I had seen a few of his tweets. I know he even follows. We follow each other on Twitter. I'd never really looked into his stuff. I didn't realize he was an MMT guy. Very cool. Love the discussion. And also, I find it quite fascinating that he's one of what seems to be many converts to MMT thanks to Bob. Yeah, you're technically right, but Murphy from that debate 10 years ago. So that was a really neat interview. But you guys are doing great stuff. I love the discussion over there, and I can't wait for part 2 to come out. But check them out over there. I don't know if I have anything else to really plug, but that's the link. And
thank you for the shout out, the plug, Douglas. I also just want to say really quick, whenever I have these debates, particularly in person with people, literally they verbatim say, "Well, you're technically right, but so I don't think we should give Bob Murphy too much of a hard time," because I've had these debates with people in person multiple times, and They have the exact same reaction. It's like, well, you're right on this, you're right on this, you're right on this, but you're just wrong.
Because, yep.
Just because, it's debt, okay? It has to be paid back. You don't know what you're talking about, okay?
Yep.
Raising rates, Argentina be damned. Raising rates slows inflation, okay?
Yep.
It's always just a story that they do come back. A lot of people also ignore the seventh of the deadly innocent frauds. I'm always big to point out to people whenever they come up with those kind of shady arguments, which are totally mainstream, right? So they're baked into almost cultural understanding of how money is supposed to work, which is completely backwards. But they also don't understand that the way that the Ricardian equivalence, whatever, kicks in and works. They got that backwards too, so that there is sort of a tax pay for later on down the road for higher government deficits today, but it's automatic. It's automatic. The tax comes in because the economy grows and strengthens and there's stimulus. You can't avoid higher tax return. So higher tax return tomorrow due to higher government deficits today is correct. The deadly innocent fraud is that it's a bad thing. It's a good thing.
Yep.
The tax receipts higher going up just shows you that you've had a strong economy. If that is the dynamic, the tax receipts can go up too because the government thinks it needs to balance, quote unquote, balance the budget. So they're creating moving towards a government surplus position, which is draining money from the economy. So that's the bad way. But so there's that subtlety about the seventh of the seven deadly innocent frauds, which is really important. So it kind of looks to people. It's like the whole sequence. They got the sequence backwards. So first Congress or parliaments have to get the money off us before they can spend. It's the same with the tax return. But so it's correct that you get higher tax return in the future when the government deficit spends today. The myth is that it's a bad thing.
Yep.
Because they've got the sequence backwards again. The tax isn't paying off any government debt. It's just automatically returns from initially the government spending.
It's just the way the math works. Yeah.
It's increasing circulation of currency in the economy. How do you increase circulation of currency in the economy without extra tax coming in? If you got sales tax, especially, you can't. You're always going to create more tax return.
Brian, how much time do you got tonight, man? I've at least.
I've got some time.
Okay, I got one more thing I want to run by at least. By all means, I'll feel free to hang out as long as possible.
Before we get to that, hey, Douglas, just one other thing about the mechanical nature of the stock market. I think it's worth noting. There was a recent paper published by GMO, who are some of the smartest, just best fund managers out there, and actually surprising to me, very, very MMT sympathetic. I think they came out with a paper a few years ago that said, why does everyone hate MMT?
Nice.
And it was basically like, they were basically like, I don't see what's so controversial about this thing. They're basically saying that, government debt is just like one gigantic quadruple accounting entry, which actually makes complete intuitive sense. So, but they basically said they were they're known to be they're known to be kind of bears. They're known to be that kind of, everyone knows that in finance, like the kind of cynical.
Yep.
But they're not like gold bug nuts.
They're not like cringe bear, but yeah.
Right.
Yeah.
Well, they're kind of, they're critical of companies that do egregious thing with accounting and stuff, and all I think healthy things that prudent, shrewd investors should be doing. But they're very what they said was they were very bearish, I guess, on the stock market back in like 2009, and the guy was basically like, mea culpa, I got this very wrong. And I went back to what I wrote and it was basically like, I didn't think that the government could maintain as high, because they were referencing the Kolesky profits equation, and they're like, I didn't think that the government could maintain this high a level of deficit spending, and the fact that they have been able to maintain it has meant that corporate profits and earnings growth has been much better than what I was predicting back then. And so he's like, look, this is, and so it's like, to that extent too, when the government spends money, when they buy a jet, that's now earnings for the jet manufacturer.
Yeah,
when they
exactly.
Send people Social Security checks, right? And they take those checks and they, go pay their rent or buy stuff with it. That's income for the person who received it. So it's just and so in that sense, it is kind of mechanical, because if the government's spending more money, that means that there's going to be more sales and earnings for businesses.
Yep.
Right. So, to the extent that those assets get bid up too, like, people are flush with cash, they have money to invest, they end up piling into the stock market. It's so I think it's really important for people to understand that. I tried to get an op-ed in my local newspaper. They've published me before, but I couldn't get it in there this time. And I was basically like, all this crazy talk about cutting entitlement spending for as a means of passing the debt ceiling is the most anti-business policies I can possibly think of. Like, there's no group that has benefited more from the last few years of increased government spending than American businesses, and that's just factually true.
Yeah.
Right. In terms, right. Yeah. Corporate profits as % of GDP are literally at all-time highs, and margins are at all-time highs, and so it's just like insane to me that pro-business lobbying groups, and I talk to people in the business world, and they think that it's crazy that the government has to cut back because all this stupid like crowding out myth, and it's unsustainable, and blah,
isn't McDonald's at all-time highs right now?
I'm sure it is.
Yeah. What are we all doing? I mean, what do we all do with our stimmies and stuff? We bought McDonald's, man. It's great.
Exactly.
Oh yeah, it is insanity. It's just it's a double whammy to working people, because you've got all this stimulus at the top end of town from the interest income, but let's suppose the rates stay fairly high for a while, then that'll continue. But at the bottom, if you have spending cuts at the base of the economy where people really need it, you're just going to be widening. I mean, the economy may stay strong, but you're widening the wealth and income gap massively. Creating kind of massive social pressures, not financial pressures necessarily, but social pressures. Financial pressures on poorer working people, lower wage folks, the reverse effect. It's like I keep saying, it's a repeller, not an attractor, and so it's just going to. I see it as sort of as a form of neo-feudalism in a sense. It's a terrible. It's just. I don't know, and I don't know when it stops too, because they'll keep on going for spending cuts and interest. Keep the
interest rate hikes going up to keep the cycle.
Top end of town. I mean, what the hell?
And raising taxes on working people by making them pay off these stupid student loans.
Student loans.
That to me is the biggest. That's the biggest worry I have right now.
Yeah.
Is the impact on spending. Because people were essentially, and this is what I like. I have these. This is one that I very passionately debate with people openly, like in person, because I'm just like, because I try not to get too political with people, but I'm just like, this is absurd. Okay, you're essentially calling for a tax hike on these people. It's outrageous to be to be, say I'm pro-America, I'm pro, I want lower taxes, I want better
That's a really good point.
conditions, and right, and then to say like, oh no, we have to raise taxes on these poor people.
Yeah,
because that's what it functions as, right? Because just like the government, the Treasury has an asset on its balance sheet is taxes receivable, right? That's the whole that's the whole MMT thing. Like that's maybe they don't explicitly write it on there, but that is what creates the balance, the offsetting balance to all the debt that gets issued, right? And so this is effectively the same thing, but the Treasury explicitly has these student loans, their assets on its balance sheet. All it has to do is just mark down those accounts, and then people don't have to pay them back. So it's functionally the same thing as taxes. It's just a tax. It's a tax for being poor.
Yeah, though, see, here's the thing: is someone who doesn't have student loans. I take it personal, right? Because what they could have done what I did, which was just I chose to be born into a family that could afford to pay for my college, right? I mean, that's right, and that's just the decision. That's just the decision they made to not be born into
a decision that you.
Yeah.
Congratulations.
Yeah.
You're
So
fiscally responsible.
Yeah. And so I have no sympathy. I have no sympathy for these. Like, listen, I had to pull myself up by my bootstraps as I came out of the womb with a silver spoon in my mouth. And that was hard, okay? I don't like the taste of silver, okay?
Yeah, to create those anti-gravity shoelaces. Genius move there, mate.
Yeah, man. Jokes aside, I don't get into the progressive politics too much, but some of this stuff is just so unnecessary. One of the things I wanted to hit on, I've been writing down a ton of notes, a handful of things I want to get at, but real quick for the listeners, Ryan, you and I are both investors. You and I both look at the market first and foremost to capitalize from it, right? To make a trade that is going to ultimately generate alpha, right? We have a similar goal in what we're attempting to do, and this is it's kind of difficult because we also deal in a world, the MMT world, that is very advocate, kind of economically progressive advocate heavy. And I know one of the issues I oftentimes have, in part just because of how my personality comes out in Twitter, where I kind of like to troll a little bit. It makes it look like, when I say we're bullish, that's some good thing for society, right? I mean, the fact that the stock market is going up is somehow good for society, and I'll take my victory laps. I want to be clear. I made this clear during the last video, and I'm sure you have the same thought in this as well. But I mean, I only like markets going up as much as it actually helps society. And what I'm seeing right now is not a benefit to anyone in society, but people who already have the ability to take advantage of the current situation in front of them. So, for those of you, we have more people watching than I think we ever have live. And Ryan, I'll let you, speak for yourself on this as well. But the current situation with the absolutely regressive high interest rate, right, which is giving money to rich people to continue to support their lifestyle, while inflation, continues to get elevated, or at least is sustained at a higher level, is terrible. But that doesn't mean that MMT as a framework for analysis still isn't going to tell me that, that doesn't kill the economy, which I want to get into later. It's going to support continued economic growth, at least insofar as it affects the financial economy, that it's going to push higher, right? The financial economy doesn't care who's growing, if it's the poor or the rich, the middle class. That it is growing is all that matters. To tie a few points together, first and foremost, I use MMT, and the reason that the Bob Murphy debate clicked with me 10 years ago, and the reason that I've stuck with MMT to this point forward, is really not because of the benefit of that this fits with my political views. It really is that it just consistently gives me a framework to predict the future, and it's worked. If it didn't work, I just move along, but it consistently works. And so I know that's why I come from MMT, with the angle I do, and why I've stuck with this MMT game for so long. But at the same token, it's at the same time, it shaped my political worldview, and it's definitely changed me over the last 10 years. And I can see things like the argument you were just making with student loans. There's no need. I mean, at this point, there's no need to continue to punish people who've been punished enough. I mean, I just look at, I think about the student loan thing to begin with, right? I remember I graduated college around like 2007, 2008. And I remember around 2005, 6, whatever, there were these billboards up that were saying like, look, if you get a college degree, you're gonna make $1 million more over your lifetime or whatever. And these billboards were all over the place in my college town, right? You remember these, right? And I'm like, if I went out there and put billboards up that if you went into debt $50,000, you'd make $1 million more in your life, and it didn't pan out for you, I better be in jail for that, right? Like, I made a promise that wasn't true. And I mean, obviously college is a great thing, and further your education is an absolute plus. But I know a ton of smart people that are hardworking that just completely got screwed over by that system. For my sake, I'm not going to get any debt relieved on my part, but it still is going to benefit me because it's going to benefit society. And it does kind of piss me off that there are so many people that just out of pure retribution want to see people suffer, even when it's unnecessary, right? I mean, if it was necessary suffering, right? Like it would crash the economy, then so be it. Maybe we figure out another way to get around this, but that's not the case. Anyway, I'm going to digress at least on that point.
No, that's a good point.
Those people are anti-capitalist and anti-American businesses, because those dollars that people are earning that are going right back to the government to pay off the student loans could have been used to spend on products and services that businesses provide. So that's number one. Number two, and part of the reason I'm so passionate about this specific issue. I mean, I had student loans when I graduated, was fortunate enough to be able to pay them off. I work in the finance industry, and a lot of what we do is we look at a lot of companies going under financial stress and or distress, right? So we're buying stressed bonds or distressed bonds. And let me tell you something. The Chapter 11 process that we have created, and it is something that was created. It didn't just appear out of nowhere in nature. It's been an evolving thing in terms of bankruptcy laws in this country. Is the envy of the world, right? America is the best place. If you're a corporation, it's the best place for you to file for Chapter 11. So because the process protects your assets and ensures, it's trying to maximize outcomes for all parties involved. And so, it ensures your business can keep operating as a going concern, while the creditors all sort of duke it out in the courts over who gets the best return on the relevant claims that they have over the company's assets. That differs from basically everywhere else. In other countries, like, there is no chapter. There's just, you're filed for bankruptcy, you get liquidated. That's it. It's over. And so I live in that world, and the fact that we treat companies that way, which is literally the envy of the world, and then we go and we treat people,
that's interesting,
human beings,
yeah, that's a really good point. Yeah.
Like, you can't get your debts, these student loans, discharged in bankruptcy. You can't restructure them. That is just so wrong on so many levels. And part of the reason is that there's no actual collateral. There's no asset that, like, a lender can seize and then sell into. It's not like an auto loan. People are like, oh, well, how about you forgive my mortgage or my auto loan? It's like, well, you know what? If you default on that, the bank can take it and sell it, and it's still a useful, productive asset. You can't like take a diploma and securitize it. And it's not useful, right, to anyone.
Yeah.
It doesn't have any utility. So the whole thing is just incredibly stupid. And then it's like, okay, you're essentially saying that these people, like you said, you were promised something, and essentially because a bunch of idiots and crooks blew up the economy in 2008, well, that they're essentially paying the sins for those people, right? Because the job market was so bad for so long, they couldn't get work, and that the interest they can't pay back their debt, they get charged additional interest penalties, whatever, and it's not their fault. They did what society asked of them, which was that they invested in themselves. And by the way, like, all these things are so interconnected. You can't get decent health care in this country unless, well, I guess it's better now with Obama, but for a long time you couldn't get decent health care unless you had a white collar job, essentially. And the only way to get a white collar job is to have a college degree. So there's sort of like, okay, well, you didn't have to borrow. It's like, well, you kind of did if you want to get decent health care.
Yeah.
Right? So you don't have, it's just so wrong on so many levels. It's why it's one issue that I get very, very passionate about.
Yeah, but all of that pressure that you've got in the system, and this is true in every country, not just the USA. But whenever there's user pays education, you create similar pressure. It's also ignoring the fact that skilled education, and as Daniel said in the chat, it could be trades. It doesn't have to be all accounting and lawyers. Skilled education is an investment in your people.
Yeah.
So in a way, I would always say, I mean, maybe it's just to troll people a little bit, but honestly, I sort of believe it, that you almost want to pay students to learn in some way, and that's what scholarships do, right? You select really talented students and you pay them to learn. It doesn't seem to affect their ability to learn. It doesn't just because you're paying. I mean, in fact, it works out even better because they then, the return is that they feel like they have to earn their scholarship. Whereas with student debt, all you want is the piece of paper so you can go out and get a McDonald's job or whatever job, and the hope that a few years later you'll be a surgeon or a lawyer or whatever, or and so the incentive is to get quit with university as soon as possible to get the debt off your back, because that is a real debt. You're not a money yet. You're not the currency issuer, and so it seems to be just all the incentives are really bad. They're badly aligned. Universities has become this graduate diploma mill, and then just because you don't have the government understanding what their role is, they come out and there's no jobs available for them, so they're working in KFC or McDonald's or whatever. So, I mean, but I agree with all of Ryan's points too. But there's even more to it, and they're so interconnected. And it just sounds to me like the two of you are like doing all the progressive economics talk here. It's like you take having kids plus understanding MMT equals a pretty progressive type of thinker, I reckon. Hard not to be.
Well,
but I appreciate all your analysis.
The other thing is, going back to the idea of like, education and capitalism and government spending and how all this works. I mean, probably I would argue, if not one of the most important American corporations of all time is Intel. And Intel, right? Like they were at the forefront of the chip revolution, right? Intel was Silicon Valley, they went public in like I think 1970 or 71 or something.
Who
right,
are they
right
employing too, Ryan? Who are they employing? All these boomers who had free education.
Well, so that's exactly I don't think they're actually boomers like Gordon Moore and what's the other guy's name? Andy Grove and them. So those guys. So it's a fascinating story. Like they were like ex-military guys. Basically, the military trained them, as scientists, during World War II and stuff. So they had this incredible technical training, technical background, all publicly funded, and that's where they sort of got their education and technical skills from. And then there was this whole drama about, it was Fairchild Semiconductor first, and then there's the traitorous 8 that revolted against the guy who was the founder of Fairchild, and they all left him one night and formed this new company. And
was it the traitorous 8? Did you say? Sounds like a Western.
I think that's what they were.
This all sounds right. I think I've heard this story. This all sounds right. Yeah.
Right, and so that ended up becoming what is today Intel Corp. And I would argue, computers, chips, computers, the internet, like none of that happens without the creation of these companies. And Intel was an absolute amazing, money, wealth creation machine for all its stockholders through the 70s and 80s and 90s, less so in the last 20 years. And that's a whole nother story. But the point is like when it's done right, it works, right? You have publicly funded education teaching people real technical skills that can then be converted into commercial use that creates both real and financial wealth for people. And I don't really think that that's a controversial, like we can all be friends.
Absolutely. But the other thing, the other thing I do, and the other thing you have with user-pays education, what does it motivate people to do? Go into high-income areas, which is the rentier sector, right? So it discourages people from the arts, even from engineering these days. I mean, I know you sort of hear big numbers about data science salaries, but if the jobs aren't there, you can have a data science degree and not have any salary at all because you're not working at the right place, or you're not in the right town or whatever. And so again, if the whole motive is you're getting education in order to get a high wage or salary later, students are going to think, well, okay, I can't follow my passion. I can't actually, be, do something obscure in tech or whatever space, engineering or whatever you want to do, arts, because I've really got to go for the guaranteed income from law.
Yeah, I think that's
real estate.
I think that's a point Josh was making out further in the chat. That yeah. And you get
that's again all interconnected, as Ryan says, and so a lot of it is also very, very backwards. You can trust people to a certain degree to choose a decent subject. If you're giving them low-level scholarships, if they're not that bright, you can still give them a scholarship to study and learn. Yeah.
That's why I got my scholarship. I wasn't that bright.
But if you give them a little stipend to study, then they're not going to choose to study, something really stupid that's not productive. It might, but they at least won't be steered towards studying something they don't really want to do just because it gives them a high income.
Yep.
And you get just a whole better society that way. It's like anti-UBI because you're giving people a stipend to do something. Okay, studying and education, getting skills is hard work. So what do you do when someone works for you, for your society? You pay them a wage. So with education, you give them a stipend. Anyway, that's my rant.
I like it. I think we're going
to. What's another topic?
So a few things. For those of you who are watching, we're going to talk in just a second. I'm going to ask Ryan to try and track my discussion on Steve Keen, system dynamics, do rate hikes cause eventually a economic downturn? What is my, what my theory is on that? We're gonna cover that, so stay tuned. We'll get to that in just a second. I have a few notes though, real quick. You were talking about corporate profits. I have I think the only Twitter video I ever pulled up, I think it was a video that I've ever put up. So I think I named the file For Real Macro Econ with Love. Real Macro Econ is one of the trolls that pops in. He's the reply guys that pop into my Twitter accounts, and he had a public post on his Patreon about corporate profits, and this was back in December. I'm petty, so I will go find people's bad calls just to call them out on it. And so he had a call back in December that corporate profits were going to crash or something like that. And so I made him. Yeah. Sorry, I'm admitting my.
I like this. I like this system we've got of keeping receipts.
Yeah, I do. Yeah. So I did, and so I did some research, and I wasn't expecting it to go this damn well. But there's almost I forget the exact I don't know if it was inverse tax receipts or something like that. It might have just been straight up government spending. But I'm and then I ran. Yeah, it's. I mean, you can almost just run a linear regression and get a high enough, a high enough p-value from this to say, yeah, this is statistically significant. But it was almost a one-to-one relationship between whatever government spending I was tracking and corporate profits lagged by a quarter or something like that, right? So you could, because he's I expected corporate profits to be lower, and I'm like, dude, I'll just write the code for you. If corporate profits is what it is that you want to track, here's the code. Just run it yourself, right? I will tell you what it's going to be before it even gets there. And so
here's your free lesson.
Yeah. Here's your free lesson. I mean, I'm like, your Patreons. You can even charge your Patreon subscribers for it, and I won't care. But I'm still going to call it Doug's MMT application. So,
right.
It's but that I thought you kind of find that funny. Yeah, corporate profits track very closely with government spending.
Are you guys familiar with the Kolesky-Levy profits equation?
I don't know the equation. I've read the. Okay.
Yeah.
A little bit of an admission here. I hate reading. I hopefully, probably not hopefully, but you can probably just tell from my personality. I am severely ADHD. My attention span is all of 10 seconds. If it isn't in audio form or it's not easily translated into speech to text, which unfortunately the PDF where this thing is at is not in easily.
You could say that. But having said that, Ryan, Douglas is a very quick learner. So all he needs is a good video. He plays it at double speed, and voila, understand.
But yes, I am familiar with the equation, and I think they're absolutely right. And it was one of the things that I ran across that allowed me to start to find all the data series that made sense. But keep going on what you're going to say.
The scary thing is, the scary thing is, by the way, so the Levy in the Levy-Kolesky profits equation. That guy's
identity, yeah.
That guy's son, this guy Leon Levy, who was a big Wall Street guy, was one of the founding partners at Oppenheimer Funds. Very successful, financier. He's the one who founded. So Jerome Levy was the father's name. His son Leon Levy was the one who founded the Levy Economics Institute out of Bard College, the one that had the MMT, which is where MMT was sort of founded, and where I went for their MMT seminar a year ago and stuff. And so I guess what I was gonna say is we've known this for 100+ years. I
didn't realize. Okay, I didn't realize it was that old. Okay, I thought this was.
Yes,
wow. Okay, I thought this was from the 1992 paper they published or something like that. Oh no way, that's wild. Okay,
yeah. When you say Karl Marx, Douglas needs a date timestamp on it.
Oh, wait, no. Hold on. Wait, are you saying the Levy-Koleski equation is 100 years old, or?
Well,
Koleski was Keynes' contemporary.
Okay. What are you saying that is 100 years old? What are you saying that is 100 years old?
Well, Levy and Koleski came up with the same equation. They came up with it from different through different identities, but it's the same equation. And so that's why they say the like Levy-Koleski or Koleski-Levy is because they both independently came up with it. And Levy was I thought he was Keynes' contemporary, but or maybe even a little bit older than him. But yeah. So but the crazy thing though is that we've known that government spending directly boosts corporate profits for over 100 years. So why do we keep pretending like it doesn't? Right? Like if you have the first thing that the first thing that you could do if you want to try to gauge where corporate profits is going is just to see where do you think government spending is going to trend. It's going to be up or down. Yeah, and if you're calling for a cut,
the corporate profits, come from the consumption plus investment equals your profits. But what happened is after Keynes and Koleski, you had the whole ISLM and loanable funds crowd.
Right.
And that just got so baked in and ingrained in teaching and economics because it was like I don't know the whole pedagogical history of that, but what I heard recently, one guy was arguing with Steve King about it, was that it's simple to teach. You sort of take all the sort of MMT type and Keynesian stuff out of the system, and then it's sort of easy to teach. It's sort of just that was the only thing. That was the only kind of excuse or rationale that I heard. It's easy to teach this ISLM crap. And so that just
the world's flat.
Yeah. And so you're not looking at accounting identities and the monetary system. You're just looking at these abstractions. And so I think that partly explains it. But yeah, sorry to interrupt you. Keep
no. That's such a good point, because it's like, why do we keep deluding ourselves into thinking that they're not that they're anything other than that? A, and B, why did I not get taught this?
Yeah.
In undergrad.
One interesting thing that Nick Gomez pointed out on your podcast is that ideas can be very powerful, right? And so even though all the supposed materialists and consumerists and that they want to dismiss sort of idealism and ideas and Platonic forms and that sort of thing, they're real. I mean, they're seriously powerful, and an idea is really powerful. And so if you propagate an idea through your education system hard enough and push on it hard enough, it does get sort of culturally ingrained almost. And all these myths surrounding money and currency have developed in a sense from academia, permeating into society, and it is a bit of a hard stretch because you've also got in popular culture these ideas that the gold is the money sort of thing. And so that's a hard one to disabuse people of, because Adam Smith and others, sort of the founders of economics who became the kind of founding fathers, were, I don't know, trusted, or they were just talked about a lot more than the people who got it more real, like the physiocrats and so forth. And so all that, so it's just, what am I saying? All that stuff is sort of baked in, ingrained. And so you need economists to actually be super aware and smart of the reality about currency, that it is just credits and debts. And these are strong ideas, and you've got to replace the bad ideas, false paradigms, with the correct paradigm. Otherwise, you're just going to get, a perpetuation of these misunderstandings and myths that, frankly, are just horrific in consequences. All lost output that we've had from unemployment, because it's supposedly some sort of natural thing to have unemployment, is just horrific levels of, it's just tragic. And so, yeah, I mean, but economists are not up to that, all right? They've got these strong ideas that are just false ideas, and you have to replace them with better ideas. And so even though Cholesky equation or, Godley's equations and tables and all that are just accounting identities, it really freaking seriously matters that you have these correct, because you can invent some sort of fictional fake ideas, as the neoclassicals and DSGE models and all that do. You can invent these ideas and they can become powerful. But if they're not matching the actual reality, the actual accounting identities, then there's no guarantee that your models, that you're thinking, that your policy is going to have good consequences. In fact, there's almost a guarantee that it won't. It's like, to use a physics analogy that Nick would understand, it's like if you write some equations that are pretty good, that sort of got some good symbols in them to model some sort of plasma energy system, or any system in physics with some energy in and out, like magnetic or electric system, but you don't enforce conservation of energy principle. And that's the only thing everything else looks super good. It looks really, really fantastic. It's all, sort of based on empirical and good theory. But you just do one thing, which is you don't in your model, in your equations, you don't ensure or enforce energy conservation. Then the model can just go completely wild very quickly, like no bearing on reality at all. So imagine a climate, weather climate model, and it's all good. It's all, the equations close, all the forms look good, all the hydrodynamics look fairly good, but they just forgot to enforce energy conservation, or some number, like they got the meters wrong, and they put some measurement in feet per second instead of meters per second or whatever, and it just stuffs up energy conservation. The equation is going to be completely useless, no matter, like 99% of it is correct. It's just going to give you completely wrong predictions. So if you ignore accounting identities, like the Cholesky equation, or Bill Mitchell's sectoral balances, you can build the greatest model that looks really cool, the greatest model in the world, but it's going to be completely wrong. It's just going to give you bad analysis. And so it really matters. And it really grates me that people say, oh, well, MMT is just accounting identities. I'm like, yeah, but it's just like saying physics is just conservation of energy. There's so much more to MMT, but even those identities, they're so damn important to understand and use.
Right.
Yeah.
It's basic principles. That kind of reminds me, I met a lot of young, some PhD candidate economists a year ago at the Levy Institute, and I was asking them, I'm like, I don't understand why your guys' profession obsesses over these DSGE models that are so clearly based on false assumptions. And what the answer I got, and this is purely anecdotal, small sample size, but what people kept telling me was that these models, these DSGE models, are very, very accurate, quarter to quarter, 99% of the time, and then every so often they're wrong, and when they're wrong, they are spectacularly wrong. And so, whereas the MMT economist models, there's also like a Levy forecasting consulting business, I think, and one of the economists that works for them, he gave a presentation and stuff, and we got to use their modeling software and whatnot. And what this guy basically says, like, look, our models are not like, we don't really have, like, looking at these sectoral balances and stuff, it's really hard for us to predict the next quarter what's going to happen, but we're really, really good as we get 1 year out, 2 years out, right? So there's sort of, these noisy fluctuations quarter to quarter, but longer out, it's dead on. And so that to me sort of says a lot too, because of our kind of institutional structure, how businesses work, how public companies have to report quarterly earnings and stuff, right? It's such a thing in the U.S. in the capital markets. Gotta hit your numbers for the quarter. That I feel like that has really something to do with it. Of like, yeah, sorry.
No. Keep going. Finish thought. This is really interesting what you're saying. Yeah.
Yeah, and so basically, like the DSGE models, I think, are a useful tool a lot of the time, and can get fairly precise projections in a lot of the time. But then because it's garbage in, garbage out, when they're wrong, they just completely blow up.
Yeah.
But what you
problematic epicycles is how Steve Keen would put it. So they're doing curve fitting on a massive scale, right? So they're using econometrics in a really poor way.
What you were saying though, Ryan, I want to make sure I'm getting this right. The Levy models were able to accurately predict further out in time, though. Is that what you said?
Yes. Yeah.
Okay.
Yeah, but because they're more parsimonious,
correct.
They use fewer parameters.
Correct.
They don't get short run noise.
This is
now DSGE models and that the basic standard econometrics you get taught in school these days can get very accurate short run forecasts, or not very accurate, but accurate enough to like pass muster, I guess, because they are built into sort of get short run noise, but long run, because they're just curve fitting, they're not actual proper causal.
Yeah, which also means then when the DSGE model gets knocked off course, like incredibly wrong, it means long term they'll never be right, because
they'll never be right
once you get off course by a couple degrees, you're heading in the wrong direction for an hour.
They have to keep resetting
for life. Yeah. This is really interesting, Bijou. The reason I'm kind of cutting in here, do you remember when we were doing a lot of machine learning work early on to determine like the perfect window for prediction, right?
Yeah.
And it kept coming back to right around a year to 18 months. Where was all the sweet spot was for all of our data. And it's really crazy, Ryan, that what you're telling me is their models were really good at predicting a year, slightly a year to year plus out, which is exactly what I keep running into, that is the sweet spot for all these deep learning models when you shove the data into them. The highest information you can get out of it from kind of a mutual information standpoint is always a little bit over a year. That's really cool, man. I'm glad you told me that little tidbit there, because
so that would be what Adam in the chat would say would be like a Keynesian model, a proper Keynesian, not bastardized Keynesian. So a proper Keynesian model is something that uses sectoral balances or the Kalecki equation, depending on how detailed you want to go into the meso economy. That'd be what you use. And the difference with that, with an ISLM, is a high level abstraction that basically kind of builds in loanable funds. Although I've heard a guy in Britain say it's not exactly loanable funds, and he might be correct, but that's essentially the gist of it without going on a big lecture on it. So you can think of ISLM. It's also got units wrong, so it confuses stocks with flows. So it's not even a proper model to begin with. But it basically is a kind of a model where you've got, endogenous money, and the lenders and the borrowers are sort of, just swapping money back and forth, and then you can work out your unemployment and whatever else your output that way. It's basically taking a microeconomics model of supply demand curves and just translating that into a macroeconomic setting where your variables are not price and goods, but are unemployment or employment and total economic output. But I don't want to give a big lecture on ISLM. You'd have to actually look into it. But it's what you call bastardized Keynes. So it doesn't use stock flow consistency. So it's not getting the, in physics, the conservation of energy correct. It's not getting the accounting identities correct, and it's just a high level sort of abstraction. And DSGE models to fill in are basically just more. Well, I think of DSGE models as sort of more complicated ISLM. So they're dealing with a supposed equilibrium between supply and demand, or in the macro sense, between sort of labor and capital. And it's just an equilibrium sort of type of model. So you try to solve the equations to find the equilibrium point, and that's it. That's apparently it, until other things perturb that equilibrium. So that's all just nonsense too. These ISLM and DSG models, because the real system, the real world is not equilibrium at all. So a Keynesian using that model would say, okay, well, at a single point in time, there's a tendency towards equilibrium, but they would move that over time. So the next day or next year, everything would have changed, and your equilibrium is not a true equilibrium. It's just moving around every day. So that would be like a Keynesian model. And of course, you modernize that by making it a Steve Keynes or MMT model, which is proper dynamics. Yeah. So that's essentially the story there.
I think the problem, whether it's a DSGE or ISLM, I think the problem with all these other models and schools of thought is that the operating assumption is that like money is just sort of this passive thing, that it just it exists. It's always, and that's just you're just starting just from basic principles. You're just wrong, right?
Yeah,
exactly. It's only MMT and the Godley Lavoie sectoral balances frameworks that puts money at the center of the analysis. Like that is what sort of drives the entire rest of the analysis is the financial sector. And so that is where I think it's like, how can you trust any other sort of model for an actual real world economy unless it's centered around money and finance? It's not a thing, and right, and it's never been a thing.
Yeah, totally.
Amen to that. Yeah, amen to that. We've hit on a ton tonight. This discussion has been great. Like I said, I had one big thing I wanted to talk to you about.
Sure.
But before I move forward, but really, actually, one of the notes I had, jumping back, like 45 minutes in our discussion, going really almost all the way back to the top. I did want to pass something by you here on the short run. Okay, so we're really changing subjects. If you have any questions, we can on what we were just talking about, we'll maybe swing back at the end here. But one of the things I want to go back to the TGA drain. I think we're all in agreement, probably in and of itself, nothing else. All things being equal, TGA drain. I'm sorry, the TGA build reserve drain, probably not that big of a deal. Here's kind of the argument that I made. Okay, so just to give a little perspective here, I started building my long position out at the very end of 2022, and effectively been in the same position that I've been in since the beginning of January 2023 to now, right? So I've sat through a lot of chop from quite a few different angles, but still kind of thought, you know what, I'm just going to hang out here. However, here is, and I'm glad you kind of spelled out the September 2019 issue as well, because quite a few things are happening all at once. One, we're going to have the June 15th tax drain, right? We also have OPEX. I don't know how closely you follow options, the options expiration cycle and kind of the dealer hedging flows and the effect they have on markets. We're also overbought.
I'm aware of it. I don't really follow it.
Okay. We're also overbought, and then obviously we're going to have the TGA thing going on right now. It does make me wonder, right? If what does worry me is maybe credit flows have been increasing in velocity more than expected, so we're going to have a higher than expected tax drain going into, and this, I guess this is maybe, maybe just kind of as I think this out loud, maybe you can tell me if I'm right or wrong here, but a tax drain that can that does overlap with reserves, correct? Maybe I'm wrong in that, but if I pay my taxes to the federal government, those reserves, the tax, I'm sorry, when my bank pays that tax to the Treasury, aren't they using the reserves to do that?
Yep.
Right.
Tax drain.
Yep. So
that's a reserve.
That's a reserve drain. So that's happening.
Yeah.
At the same time.
Tax. Yeah.
At the same time, the TGA drain is also happening, right? So there could be a situation where I know the Fed.
But my point was the TGA drain is really additive to net financial assets, to overall credit growth. That was what I was kind of getting at the beginning, because the Fed has to create the credit,
which they
ahead of time.
Okay, how do they create the credit ahead of time?
They can advance the reserves to the commercial banking system, and that's what creates the reserves that then get transferred to the TGA.
So what you're saying is
get spent back out. That's the whole thing.
And the Fed can do that without any government spending ahead of time anyway, correct?
Right.
Okay.
Right.
Okay.
But no, that is how the Fed does it.
But okay, so that's I guess that would be the thing. This is like the one kind of hang up that I have is that there is no spending occurring this time, right? It is just the issuance of now a backlog of treasuries, right? Like normally there would be spending, there would be treasury, there would be spending, there would be treasury, spending, treasury. As of late, it's been spending. Never been a treasury, right? And now all of a sudden you're gonna get a backlog of the 5 treasuries I just skipped over, right?
Yeah, I mean the thing is, and to the extent that you can sit yourself down for 20 minutes and read Stephanie Kelton's paper. I don't know if you have before or not. It's really worth listening to. Or, reading, because one of the points she makes is that this happens all the time. You get irregular.
That's a good point. That's a really good point. That's a really good
point.
From the
Treasury,
You're right.
Because spending happens constantly.
That's a really good point.
And taxes only get paid quarterly, basically, or something. So there's this whole coordination between the Fed and special depositories. Now, this paper is a little old. I think some of the operations might be slightly different today. There's reference made to tax and loan accounts at banks, and I'm not sure that's exactly what still happens today. But the point being is that there's this constant coordination, and we know that payment flows are going to be irregular. We can't anticipate what people are going to do, and so they have these processes in place to ensure that the Fed can always create additional credit, can always credit reserve accounts at commercial banks if need be, or remove reserves in pursuit of its policy rate. And that's how the institutional structure works. That's how it always works.
Yeah, that's a good point. That's a good point. I take essentially what you're trying to say is there are 100,000 flights every single day in the world, and every airport knows what they're doing, and you never get a plane crash except for maybe once a year, and it gets headline news. And it turns out that September 19th blip that we saw, or September 2019, was the one time where maybe the timing wasn't perfect with the Fed and all the other institutions that need to be perfectly aligned here. But every every day there is things that have to get solved. And what you're going to tell me is there was actually a real cause for what happened in September 2019.
Yeah, it was the Trump tax cuts. So
okay,
I think they have to change their projections about receipts and disbursements.
Yep.
And,
okay.
I think the Treasury receipts were much higher than they anticipated.
Okay.
So
Okay.
It's because the first year, I don't know if you remember, like 28. So they enacted it in 2017, and then 2018 was like the first year where the new rules went into effect, and there were all sorts of weirdness, like companies like took tax charges that they normally wouldn't have because they want to lower their taxable income for the year, and then going forward they wouldn't have to pay as much in tax. Like there was all sorts of stuff.
Yep.
All sorts of weirdness, and then so for whatever reason, and the Fed actually did a post-mortem, and you can find it on the Fed's website where they explain all this.
Nice.
Where,
okay.
They sort of explain what happened.
Okay, I'll have to look that up. Text to speech, baby. we'll let the computer read it out. Okay, that was. I'm glad I finished that. So I mean, pretty much, I think what we can all agree on, if markets do, I mean, one, the TGA liquidity crowd will probably end up getting to take a victory lap, even though it's probably not for the reason that they think is going to cause us up. We've just been running hot for the last week or two. Stocks usually take a break. Just out of the way kind of momentum works. I have been, TGA notwithstanding, I have been thinking that we might end up getting a bit of a sell-off happening here, not at the end of this week, but into next week. But it's really hard to time. This is actually, just to kind of go off on a side tangent here, one of the things I was talking about in the Patreon update I dropped last night is it's very, very difficult. I used to try and time shorter term moves with a higher frequency, and I've kind of given up on that, mainly because, and it's kind of just some insight from someone who's had some trading experience. For those of you who might be getting into trading, one of the most difficult. Okay, when you have sudden high momentum moves that occur in markets, right? It's very that momentum needs to kind of reset, right? So I mean, the price is going to go back down to the mean. It's going to happen in one of two ways. It's going to happen just because price will consolidate sideways over time. The mean will catch up. You get back to the mean, or price actually just quickly plummets back down to the mean, and then you get kind of a mean reset before the next move happens after that. You don't know what price is necessarily going to do at that point, and this is why trading is very difficult. Is that and by trading I mean trading in the short run can be very difficult. Is you could see maybe a pause happening in price. You don't exactly know what it's going to play out. Is it going to be that sideways consolidation, or is it going to be a sudden plummet? So you get to the sidelines. Well, if it's a sideways consolidation, you're anticipating some sort of pullback to occur that never occurs, and then all of a sudden you just get the next move higher, right? The next wave of fiscal spending hits, and then markets just propel to whatever next level it is that they're gonna consolidate at. And this end of June OPEX cycle is just kind of this window where I think we're going to see at the very least this momentum begin to wane, possibly even pull back. But the decision I always have to make is if I'm going to get on the sidelines, the most difficult thing to do, and Bijou, I've used this line before, and hopefully this gives a little more clarity to what I mean. That train can take off without notice. And once that train gets taken off, it likely means you're already back into new, relatively local highs. And it's hard to buy into any stock or any market that is pushing recent highs or year-to-date highs or 52-week highs. You don't want to be that guy buying on the all-time high uptick. You want to have obviously been on the train far before. So that's one of the discussions I know I've been having with my Patreon members as we head into this OPEX cycle. But I'm glad to have the full discussion with you guys and kind of sort it out. So I mean, we'll see how things play out going forward. But yeah, thanks again for that last point. I did appreciate it, and hopefully everyone in chat is appreciating it as well. Do you have anything else you want to add to that discussion, or?
No.
Okay.
I think that.
Okay. All right. Moving on to the next discussion. The one thing that I really want to have, Ryan, you and I have been discussing in kind of behind the scenes. One of the questions. I would really say it's the great debate left in kind of the heterodox MMT world, and that is really what's going on with interest rates. From interest rates, how it affects growth, inflation, that whole discussion. Is there finally a point where high enough interest rates will make it will be an impediment to growth? My argument I've spelled out. I think you're in line with me. Maybe you're not. Higher rates increase the term structure of prices, supply the additional interest income to support that, and this is kind of the thing that makes sense in my mind. I think I found some data to kind of prove this as well. Is that it also essentially encourages demand for that additional income, because the counter is there's high propensity to save. The people that are getting that new income, they're not going to spend it, which even then, if they're going to save it, they got to save it somewhere. They're just not going to put it under their mattress. It's going to go into some financial instrument, right? So even savings to me means market higher to a certain extent. So there's that aspect to it, and I don't see, unless the Fed were to do something absolutely wild, like take rates from whatever 5-6% that they're at and put it at 20% overnight, right? I don't see a rate at which rates get that will actually be the determining factor to a market rollover and an economic rollover, right? I think there are other factors that could come into play, but it's never going to be the rate factor. I know during the interview with ANG Trades, he had kind of a theory as to why rates could get to an eventual point where I don't know what to call it, terminal velocity. I don't know what to call it, but at some point you get into a situation where it could start decreasing demand. What are your thoughts on the whole subject? I mean, let's just, and then I'm going to have some questions too about kind of interbank workings on bank balance sheet workings as well, to maybe test out another theory I might have and to see what you think of that, since you have kind of an expertise on the banking side. But give me your take.
So this is how I think about it, and I just want to start by saying it's important to like use your brain. And I don't mean you, I just mean like for one to use their brain and think about, recognize that there is such thing as, novel situations. And I think Warren Buffett has this great line of like, trying to, predict business or stock performance based on, past performance is like trying to, drive while looking in the rearview mirror, right?
Yeah.
And there's only so much that back test
Yep.
can really tell you about stuff, and you have to think about the reality of the situation that you're in. Like one memory I have, Douglas, are you a baseball fan?
I'm aware. I'm aware of American baseball. Yeah,
I just remember, I think it was I was in middle school, and there's this whole thing like the Yankees. I'm a Yankees fan. Went up 3-0 against the Red Sox, and there's all this talk all over ESPN.
Okay, I was in college when this occurred, but yeah.
Right, and it's like, no teams ever come down from 3-0, and this was the ALCS.
Yep.
And boom, to my dismay, what do you know? The Red Sox won 4 in a row, and I think they swept in the World Series after that. So it's just like, oh, no one's ever done this before. That's why I kind of love sports. It's like it's this stuff always happens. Well, no one has done this. No one's come back from this, and that just because something has never happened before, it doesn't mean that it can't happen now. And so when I think about the current situation, and there's multiple things to consider. One of them is that the debt to GDP ratio is extraordinarily high, right? It's like around 120%. In prior hiking cycles, it was not that high. Okay, that's number one. Number two, we live in this so-called ample reserves regime, and we've been living in it basically since the financial crisis. So banks have tons of reserves on their balance sheet. Okay. Number three, the Fed pays interest on reserves now. Okay. In past, decades and past hiking cycles, that was not the case. And I think it's something that is so underreported, so underappreciated.
Yeah.
Okay. Because, the Fed has essentially taken all the treasuries and agencies, put them on its balance sheet, and stuck the banks with reserves instead. So the banks used to hate that because they wouldn't make any interest on those reserves. I think Mosler, and I don't know if it's soft currency economics or 7 Deadly Innocent Frauds, or maybe both, refers to this as like a tax, essentially, like a reserve tax, right? Because you're taking you're taking an asset that generates positive income away, and you're replacing it with an asset that doesn't generate any income. So the banks hate that. So now they have, as of 2008, they were able to, earn interest on their reserve balances. The thing was, though, because of, the crazy, economic orthodoxy world that we live in, the Fed kept the rates paid on reserves extraordinarily low for a long time, for over a decade. And so, we didn't have this. So basically, we're doing a lot of deficit spending. That's adding a lot of treasuries. Okay, the Fed isn't buying those treasuries, sticking it on its balance sheet and replacing it with reserves. And those reserves don't pay much in the way of interest. The treasuries that the Fed was buying were actually paying more in interest, and so the Fed was running was generating a profit, and by law to remit those profits to the Treasury.
Yep. I'm gonna actually bring that screen up. It's a remittance due to the U.S. Treasury, correct? That's the Fred table, and it quickly reversed course here in September 2022.
Right. Exactly.
Yep.
And so just if you think about this for a second, and I was going back with Moser at the beginning of this year, where I'm just like, this is actually insane. So basically, we've never had a situation where national debt and reserves make up such a huge portion of bank balance sheets and GDP, and then all of a sudden, right? This is all novel. 120% of GDP for the national debt, ample reserves regime, and all of a sudden the Fed decides that they're just going to start cranking rates. Okay.
Yeah.
Now, recall too, because there's people like, that's tightening financial conditions, and that's like a whole nother thing that I don't think we have time to get into tonight. But I think part of the the banking, the fears that led to the run on a few regional banks that we had in the first quarter, that's a whole nother subject too. People are like, oh, this is tightening, it's restraining, you're impairing banks' capital. Well, first of all, no. If they don't have to sell those assets that are trading at a discount to par, there's no impairment. Okay, that's number one. But more importantly, the Fed has, by virtue of the ample reserves regime, has bought all these treasuries that are now trading at they pay very low coupons, so they're now trading at big discounts to par. So the Fed is eating that convexity, right? The mark-to-market losses on those treasuries, the Fed records it on its own balance sheet, right? The banks sold those assets, and so they have reserves.
Interesting.
They have the settlement balances.
Yeah.
The settlement balances clear at par, and they pay interest. So there's no impairment, right? If they have to release reserves to make a payment or something, or to settle deposit outflows, that they don't have to. They just send the reserves to the other bank without no impairment to the capital account. So whereas before when it was just T-bills and bonds and stuff, those will actually trade down if you crank rates up too high. In this case, they trade at par. It's a floating rate instrument. So the banks just collect that income. And if you look at the Fed's balance sheet and stuff, it's currently recording a negative capital account. My point is that can correctly be considered a positive capital injection to the banks.
Yeah. Yep.
Right.
Yep.
The Fed's negative capital is positive capital for the commercial banks, and that's why that's happening, is because the Fed has eaten all this convexity, and the banks are left with settlement balances that used to yield nothing and now paying 5%.
Yeah. Yep.
And
Yeah.
that
Yeah.
in and of itself is very stimulative.
Yep.
Right?
Yep.
Again, the banks you had extraordinarily large bank failures in the first quarter, and yet there was record U.S. bank profits in the first quarter of this year. Record.
Yeah.
And I can guarantee you that was not because of capital markets activity, because the capital markets are still, in terms of deal activity and stuff, pretty shut. It was insane. 2020, 2021, 2022 shut down. 2023, some glimmers here and there, but for the most part, it's pretty shut. And so it's not from deal activity in the capital markets. It's from, more traditional commercial banking activity.
That's interesting. Yeah.
So that's why I kind of go into this. People they say all the time, well, positive rates, like, well, I don't, I'm not going to spend the extra $20 I have in my checking account. And first of all, there's going back to the, Koleski-Levy profits equation. It's adding, no matter what, it is adding to overall corporate profit.
Yep.
But number two is that this can correctly be thought of as essentially a capital injection to the banks by the government. They're the ones who hold the settlement balances that earn free money. Okay, that's on the commercial bank's asset side. On the liability and stockholders' equity side, that gets considered as income. It accrues to retained earnings balance, which is part of stockholders' equity. So that is directly growing the stockholders' equity in the bank, right? The bank equity capital. And so if you have essentially more equity capital in your bank, that creates additional capacity to make loans. And banks tend to be pro-cyclical. Right. And part of the reason is that there's debates about is it because things are more creditworthy and stuff, and it's sort of like, well, companies are more creditworthy because there's more credit available.
Right?
Because banks are sufficiently capitalized to make the
next loan that then allows and then there's extra income, and then the income cycle kicks higher, which then makes them more creditworthy, which then gives more capacity to make
right.
It's an upward cycle.
So
Okay.
It feeds onto itself. So that's kind of my whole thing.
Okay.
It's sort of like, maybe you're not directly benefiting, but guess what? You're employed. Your companies have access to credit. They can make payments. They can generate income, and the income's there, right? And so when the income's there, that's creating additional capacity for new private sector loan creation. Go
ahead, man. I'm sorry, I'm cutting you off. No, you're on a roll.
No.
This is where that chart that I posted today, I got to do. Unfortunately, it only goes back to 2014, and it's like done every 3 months or something like that. I think they only have 3 measurements a year, but it's called the reservation wage, and it's the average lowest wage the respondent of this survey would be willing to accept a new job. And it's based on my quick little eye assessment here, it's really been accelerating over the last couple of years, and really continues to accelerate as rates go higher. And I think to me, and I can't articulate it, but you were doing a great job. You're going over all of that. When the price level, and again, this isn't necessarily the price of any individual commodity or asset or anything like that, but when the term structure of prices gets pushed higher, like if you're 20 something and you want, you're in your starter home, you want your forever home to be your next purchase, right? That your income needs to be higher than it would have been at a 0 interest rate regime, at a 5 interest rate regime today, right? So you're going to demand a higher wage, right? And not only, obviously you're always going to want a higher wage when you move up, but as a whole, on the macro whole, we should see an acceleration of that demand for a higher wage as interest rates go up, because the cost of living, the cost of doing business as a whole, is going to continue to push higher. And I think that's how the income gets shaken out, if you will, of the banking sector, and then of course, I mean, the banking sector has every incentive to do it because they're thoroughly capitalized now, like you were saying. I think you and I are on the exact same page here, man. I see this as really, I actually made this point again last night in my update. I actually think we're in a bubble right now. We are actually in the bubble that everyone feared we were in following the great financial crisis when interest rates went to zero. We are now in the bubble, and we're in the bubble because the minute the rates come back down, this all goes in reverse. Bijou, I'm going to let you jump in here, and Ryan, kind of think about this, but that's my thought. And I'm gonna try and give you the 60-second elevator pitch on Steve Keen and the math that's there. But I think we are actually in the bubble, not like a .com bubble. This is really going to be bad when it ends, or I mean maybe it will be, or even a great financial crisis bubble. But I actually think we're in the bubble right now, and it's when the Fed takes their foot off the gas that is when the risk is going to come in. Again, partially because of the dynamics that I see playing out that Steve Keen and Ty Keen's and those who have done, and the dynamics of in the Minsky software. But that's my assessment. I also liked how ANG traders put it, man. I mean, this thing could run to levels that I don't even think we could believe right now before it's all done. I mean, I also have that going as well, because until oil gets to like $200 a barrel, I don't see a big enough impediment hitting markets to it's a big enough tax essentially on the consumer to kind of kill the upward spiral that we're seeing right now. But Bijou, I know you want to jump in, so I'll digress.
No, firstly, what Ryan's story just there seemed to agree pretty much exactly with your last weekly report that you gave on the one that I mentioned to you on YouTube that I thought was really good. You went through it, and it was. I think you guys are in agreement. I think I'm in agreement too.
I was hoping for a big disagreement, a big fight, but that's not going to take place.
but I've got a thought. You could comment on about why maybe there's obviously many reasons, but one reason why a lot of other people, the mainstreamers and all that, get it wrong, because and even a Steve Keen modeler might get it wrong. They've got fixed exchange rate thinking. So if you're going to promise to deliver all these payments in the future, you better have, and you're going to increase the currency gauging, and it's basically a re-gauge. It's not necessarily a bubble. You're re-gauging, defining the currency down by giving away all this interest income. You're just re-gauging prices in a sense. If everything's working smoothly without too much friction, you can always do that on a floating exchange rate. You cannot on a fixed exchange rate, and that's what so many, even PhD economists just don't seem to absorb or understand. And the last point on that is that whether it's a bubble or not, you guys would have to tell me. I don't know, because if it's just more or less a re-gauge, then the economy can take that for a long time. And so a real bubble that would be burst by dropping rates would have to be something something real, or something that had enough of a consequence to sort of change all the market psychology and so forth, and to force people into savings mode or debt payoff mode instead of spending and consuming mode. That would be the mechanism for a recession. But yeah, I mean, where is that? Is there any actual bubble to pop, or is it just going to be a slow drop, like Derek McDaniel would say, is that the higher rates, in a sense, can smooth off the supply shock and inflation, in a very regressive, highly regressive way, as Douglas said in his report. But it can smooth it off, and you can sort of tail back down to a less hot economy. So I don't know. Those are some three thoughts.
Ryan, let me do this. Let me explain as quick as I can kind of what Steve Keen shows in his models. Bijou, fill in the details that I leave out if I leave out anything important. But the what I'll just kind of call the Minsky debt deflation. I don't want to call it a hypothesis. I mean, it's a theory. It's a it's a well-established theory at this point. But effectively, what it says when private debt to GDP is sufficiently high that when you see a slowdown in acceleration, so I'm not even talking velocity, I'm saying a slowdown in acceleration, right? That the private debt level can continue to rise, but it needs to continue to rise at an accelerating level to maintain the growth output, right? And because of the way the math works out, if you see a deceleration, you can actually get a reduction in GDP, even though private debt to GDP is still growing. It's just that it's not growing fast enough, right? So it's really the acceleration component that's the most important. When he builds his models, what you end up seeing is that how this plays out in terms of the dynamic that takes course is it's either going to be a slowdown in the issuance of new lending or a increase in the repayment of current outstanding debt, right? So that's going to cause the deceleration. Right. Okay, Ryan? I know I'm mentioning system dynamic.
Why would there be an increase in current outstanding debt?
Well, that's just the people at the bottom of the ladder who aren't getting any interest income, and they're at the moment with jobs growth, okay, they're being sustained, right? But if there's a tightening, well, I don't know what you call it, tightening or loosening, but if the labor market gets a bit wonky and people find it hard to get jobs, and there is an increase in unemployment for some reasons, or the oil price spikes or whatever, then at the bottom of the ladder, when no one's getting the interest income and they're relying on trickle down, then you get elevated private debt levels. And in the Minsky model, that was what will cause the Minsky crash. But it's a macro model. And so if you want to build one, maybe Ty Keynes has got one, but I'm not sure. But if you want to build a model that has a Minsky crash in it, in the current environment that we're living through, you'd have to have, you'd have to split the consumer sector into like the rentiers and the workers, because it's at the worker level, people who aren't getting any interest, who are relying on the trickle down, aren't getting any interest income, relying on jobs growth, then they are the ones where the instability could propagate through.
Ryan, re-ask your question though, real quick. I want to make sure I heard you right. You said.
Sorry. Yeah, I was just asking why there would be an acceleration in debt and debt pay down.
An acceleration in debt pay down. I think that would be because of more of a psychological concern, based on at least what I kind of think what Steve Keen would say. Why the debt pay down would accelerate? Yeah. I also think you get an acceleration of pay down if you get the velocity of money to kick higher too. I think you could make a case if there's just a higher income and the velocity of money kicks higher, then you could then that would, in theory, increase the rate at which you could pay down your current debt, which wouldn't throw the model off, assuming you continue to just incur new debt, right? So I think I think the way you'd say it is as long as new debt is accumulating faster than old debt is being paid down, you're going to get a continued upward trajectory. You're going to get the necessary acceleration to fend off a bubble pop. Yeah,
that would be true. But the question is when and
I know. I understand. I just want to make sure. I want to make sure Ryan's understanding the Steve Keen dynamic, and then I'm going to give what I think will cause it in just a second.
Okay. I guess the one thing I would say or push back with is that I think aggregate. I really come back to like sort of balance sheets and sectoral balance sheets and stuff, and just point out that debt pay down was really high, in 2020, 2021, because debt pay down actually the biggest use of cash for people by with the the stimulus checks that they got and stuff. So they actually, because the government was willing to issue its own currency to people, essentially, like, they were able to use it and cancel the debts that they had, and that actually freed up capacity for additional spending and new, more productive borrowing, perhaps. It was essentially like a massive private sector deleveraging that was associated with a huge economic boom. So I guess I'm a little bit.
It's a good point.
Yeah.
I think
the classic Keane-Minsky model is when the government is running pretty much a balanced budget.
Correct.
So they're not supplying the injection needed for people to pay off debt. That's the Minsky moment. So it's all more of a private endogenous money circuit type of dynamic where you get euphoric expectations. There's a bubble. Everyone's happy on the way up. The government is not providing the currency injections or increasing the government debt. And so private debt accelerates faster than the debt payoff can be sustained.
Right.
When people get into that position, oh boy, that's game over. Once you start just net, your bank balance starts shooting downwards, it's going to accelerate because of compounding debt. And that's the Minsky thing. So the point is, I think Ryan's making, and I agree with Ryan, is that we don't have that at the moment because the current governments are supplying the currency.
Okay, this is my point, right? This is going to get to my point. This is going to get to my point. This is going to get to my point. What ends it, right? What ends it? It's a reversal, right? Okay, so that was Ryan. I'm glad you brought that up. That was a good point of clarification, right? That we did see the massive fiscal stimulus, right, that offset whatever potential danger might have been there from the private debt side slowing down, right? So I mean, we can offset potential damage from a private debt reduction, and now we have the capacity to continue to accelerate going forward, right? And I would say we will continue to accelerate going forward, assuming we stay on the trajectory of higher interest rates infinitely into the future as well to match that, right? Because that is now, I mean, unfortunately, in the not too distant future, it will be the primary supplier of new private sector savings to continue to expand the private, right? So here's my thought, though, is that if, let's say something like we get a massive run up in oil, right? Let's say all of a sudden oil hits $200 a barrel. Obviously, that's going to impede demand. The Fed might see some. It'll both be inflationary at one time, one side, right? Because all prices are just going to go out of whack, right? But also, it's going to start to impede demand because prices are just going to, start to fly higher, and everyone's going to be paying so much more for just kind of the base stuff in their life that is, gas and that sort of thing. So the Fed might see some pressure, and they're going to be like, okay, we have finally hit the point here. For whatever reason, we're going to take our foot off the gas, right? In fact, we might even start to bring rates down from 7.5%. Let's just say we're in the future, 7.5%, 8%. We're going to start bringing rates down. We want to get rates down to 4% by 2025, right? Or whatever. That's what they communicate, right? So all of a sudden, we start seeing this reversal, right? And having now kind of that Steve Keane-Minsky dynamic in mind. It seems to me that we could get a reversal of everything positive that's kind of had this reinforcement dynamic to it unravel, right? Because now the term structure of prices is going to start to flatten out. We're going to start getting lower income because of the interest payments into the banking sector, and because of that term structure of prices beginning to lower. The constant demand to pull that new fresh income into higher wages and that sort of thing will also flatten out. And so the need to continue this kind of upward acceleration of new credit expansion also begins to flatten out. And again, I think that the insight that Steve Keane in that heterodox school is like spot on with is you're going to see the acceleration potentially dip low enough that even though we'd still continue to see GDP growth, even though we'd continue to see credit expansion, it's not going to be fast enough to support what is necessary to continue to see growth, and that is when we maybe see a bubble pop. So my thought is a couple things, this is just, I think your expertise is going to be helpful here. As bond prices go higher, maybe this is what you were saying earlier, as bond prices go higher, bonds are obviously on the balance sheet of the banks, those asset prices are going higher. Doesn't this get in the way of their leverage ratios to create new loans?
So if the bond prices go up, does that get in the way of them? No. No.
Okay.
Not necessarily. Although you're not getting, and what's funny to me is like, kind of what we were getting before. There was this idea that if the Fed brings rates to zero, that stimulates asset prices supposedly. And that'll help repair bank balance sheets following the 2008 sort of crisis, and they rebuild their balance sheets, rebuild their capital accounts, and then they'll be able to make loans. And I read that once and I think to a certain extent, sure, you can get like a one-time gain on on your bonds, but then the problem is, you sell them, and then you're making 1% again or something. Let's say, right? Like,
yeah.
And so then the yield on your assets, on the assets in your portfolio goes down. So you're definitely not going to be paying out as much on your customer deposits. So that income channel to households and businesses goes down.
Peters out. Yeah.
And then so that also just means generally lower income spending by the government. So there's less of that money being injected into the banks. It just means less credit, less capacity, right? There's lower net income. That means there's less income to support credit growth, right? Credit growth is a function of there being income available to support paying it back. And so if you lower income, then you're going to have less credit growth because there's not enough. There's not as much capacity to pay the debt back. So I think that's largely what happened post financial crisis. And if you look at like performance of financial stocks, horrible.
Yeah.
Terrible. I mean, languished for years. Right. The only things that worked were like kind of techie growth stocks, and I have my own sort of opinions on why that was the case, and it's not what most people argue. Most people argue that that's because of zero interest rates. I think that's totally bogus. I think it has more to do with the institutional structure of Facebook monopolizing photo sharing and social networking, right? And then you also had a situation where, GDP growth was very slow and unemployment recoveries were very slow because even though we were running deficits, the deficits were not sufficiently large to really, stimulate the economy. And so stocks that normally would have benefited from stronger GDP growth didn't, so there's no growth, so investors don't care, so they look for stuff that is growing.
Interesting.
So
okay.
That's kind of my take.
Yeah.
On sort of what happened, and but again, we're running, I think, deficits in the 7% range. They averaged around 3.5% from 2013 to 2019. So while if it goes down, sure, like that, that'd be bad, and maybe we get a recession, or maybe, stock market rolls over or something. But I don't think you get some sort of real catastrophe.
Okay.
Unless you get oil to 300 or something.
Yep.
then you've got problems.
On a side note, I was just noticing the Norminator had put out a clip just today. I think I'm not sure because I just quickly glanced at it, but I think oil production is solid, and so the price of oil isn't probably going to go up anytime soon. Oil exports maybe. I don't know. I'll have to go back and check it out. So it doesn't look like there are too many red flags on that horizon either. So like I say, like you keep saying, this could go on for a while.
I think the Saudis have been cutting production, and I think that's mostly a function of demand from China being weaker than expected.
Right.
Do you, Ryan? What is your take then? I mean, just to kind of go full circle here, do you have an end game hypothesis, or is it really just we don't know? There really is none at this point. It hasn't. If it is out there, it just hasn't shown itself, and at this point, maybe even doesn't exist.
I don't have an end game hypothesis. I'm personally, I'm pleased with some of the momentum in sort of this resurgence of domestic manufacturing, and so
that's been wild. That's been absolutely wild.
And it's something that sort of I've been reading. There's a lot of political momentum in this country for that, and it's been building for years and decades, if not. And so for me, like what I'm trying to look for are opportunities that I think can really capture some of that, because we've deemed it politically necessary to have these critical industries, whether it's for national security concerns or health concerns or what have you. So they're finding something where there's really a lot of political tailwinds for this thing, similar to the way there was for Facebook in 2012 and whatnot. The future is so great. So we'll the FTC will sort of look the other way when they're clearly trying to monopolize a certain industry or what have you. So I think there's still opportunities like that, but just in other industries. And also it's sort of like, well, who were the bad guys getting called in for all this congressional hearings post 08? It's all the bankers, right? We're seeing less of that today, and a lot more scrutiny on these tech companies. And
that's a really good point. That's a good point. That's a really interesting point.
And Lena Khan at the FTC has been really, really tough at with regards to mergers and acquisitions and enforcing antitrust laws. So it's like, okay, if that, then what does that mean, right? I mean, we're talking about a person who was widely supported by some of the deepest red states in the country because the ranchers out in Montana were getting totally hosed by all these meat oligopolies, and they were kind of rigging all these auctions for these cattle and stuff and squeezing out the ranchers and taking their margins. And so now all these family ranches have to close down because they don't make sufficient income, and then they're engaged in made in America fraud where the meat gets imported from the beef gets imported from Brazil, but then they pack it in the U.S. and they say it's made in America, but it's really not. So there's just like all this. That's the kind of stuff where I try to spend my time. Like where is there real sort of shifts happening, whether it's political, whether it's laws that are being passed, industries that we've deemed are critically necessary, versus other ones that might be kind of scrutinized. And I think, that's something to really consider, in terms of, think about markets and companies to own and I try to do my best to think about stocks as, partial ownership shares of businesses. So, that, I guess that's my sort of end game.
Nice. Okay.
I did have one question or comment for you guys before we get off here, if that's okay. Do we still have time?
Man, we got all the time in the world.
So this is my one thing, you used this term earlier, and I've heard you guys use it before. I'm skeptical about about so-called velocity of money.
Okay.
And the way I kind of think about it is like, velocity to me it's sort of just like an identity. It's not a real thing, right? Like you can measure prices, you can measure, you can come up with back of the envelope estimates of the so-called money supply, right?
Yeah.
But like to me, velocity is just like, okay, we're trying to back it. We're trying to back into this. We're trying to get this formula to work. We have these inputs. They're measurable. They're observable. So we're just gonna sort of for this last variable, we're gonna solve for it, and we're just gonna call it velocity, and that's what it is. So I'm just like kind of skeptical that like velocity, that like, and again, I'm not an expert in like all these different uses of but I'm just, to me, that's always, I've just been, so I just wanted to introduce that and maybe just throw that at you guys and see what you think.
Bijou, do you have any thoughts? Maybe Bijou uses the word velocity just because I do.
I know it's related to causes and effects. So, for example, if there is a Minsky dynamic, and I think we've established we don't know yet, right? Because what's going to pop? What euphoria is there with everyone thinking pessimistically? So for a John Maynard Keynes Minsky type of euphoria, you have to have people actually being euphoric, and you have to go into a Ponzi position essentially in some sector. Anyway, but the velocity, I mean, when you define terms, you're just defining terms, right? The question is what cause, what effect does it have, what cause does it have? So if you increase credit and savings don't increase at the same time, you don't have the leakage. So you're going to have higher velocity, and if you don't have the quantity to match, you're just going to have higher prices. So in a sense, all those, they all work out kind of like as identities, but they matter because it affects the look and structure of your economy. And the other thing is with credit.
Savings,
sorry, go ahead.
Don't credit and savings, isn't it the same thing?
Savings as a stock, right? I'm not talking about rate of change of savings. So if whatever leakage is going into a saving account is a velocity, I guess, of savings. But at the end of the day, it depends on whether you're talking about like a 1 year change in things, which is a flow, or just the current stock of things. And so like saving stocks don't really matter too much at all. It's what people are doing with them, whether they're taking them out, and the rate of change of the savings. So that's what matters, right? Rates of change. But to a first level, just think about the economy as like your bathtub, classic Norminator analogy. And you're producing, you have a sort of a healthier economy if the circulation there is faster. If you put it dirty water in, which is credit money, in a sense, you can think of the circulation as not so healthy. It's not as fast. If you put fiat money or currency injections from government or interest payments in, you get, to use an analogy, or it's a metaphor really, you get cleaner water and you get faster flow. And so that affects the look of your economy. So it really does matter how, not so much the velocity of money, but how the velocity is being generated. The other thing that matters is the rate of change of the velocity, which is exactly what you were saying earlier with a sudden drop in interest rates, or what did you say before? You have a sudden change in the term structure of prices or rates. The whole story that you were talking about before with suddenly you find yourself now in a low interest rate environment. It's not necessarily going to be bad, but it's a one-off. It's a sudden effect if the rates drop too low, too fast, and so that matters as well. So that's the other thing, that
volatility of a certain price or a certain outcome can kind of muck things up a little bit.
It can muck things up, exactly. So those accelerations are far more interesting, if you like, than just looking at the velocities, because the accelerations are what are the driving force for any sort of sudden changes, or changes in structures, changes in where where production is going as well. So it all matters. And so I don't disagree with you, but you got to take into account accelerations as well, which is exactly the effect you were talking about earlier. Suddenly the rates go to zero, and then suddenly you get a sudden increase in credit growth, but it's not going to last. It's going to peter out, and then you're back to a sort of a stagnation.
Which isn't
if the government isn't creating.
That's what I was going. Keep going.
To offset if the rates go to zero, the whole point of ZIRP is that it gives space for government to be injecting money in a targeted way. So you do targeted fiscal instead of leaving it up to private credit markets on a higher interest rate, where you get stimulus that way. So the type and quality of stimulus really matters. And to your point, or again, Ryan, maybe this is the last thing I'll wrap up, is that it does matter because, like you said, there are tailwinds, especially in the United States, but believe me, here in New Zealand as well, for massive infrastructure and light rail or electric or all sorts of things that housing that are way behind and need to be done. And you're only going to get that with governments. The markets seem to be incapable of doing that. So you're not going to get it on a high rate, credit driven economy. You're going to get it from zero interest rate, because that allows governments to inject more currency, and
without causing inflation.
Yeah, without causing an inflation, because they're injecting the currency to pay the tax, essentially. So that's why you do ZIRP.
It's only injecting what's needed in terms of currency. It's only injecting what's needed to pay, for the the wages and the capital, etc. It's not paying interest on top of that, so it's net saving.
Plus, it's investing in real goods and production, the affordable homes, all the infrastructure. It's going to benefit society, even if there's an inflation from it, but it shouldn't be. Also, it's satisfying savings desires, right? So there's always savings leakages. People have insatiable desires to save. So your government injecting the currency is not going to cause any inflation to that kind of first order effect. It'll be way second order. It might cause inflation if it's done too fast. Like if they're spending and they're pulling resources out of the private sector that were doing, bullshit work or whatever, or the latest AI that really isn't AI, and they're pulling it into education and housing and green energy and whatnot. Then you do that too quickly, you're going to, cause some prices to be affected, and that could have ramifications, right, for the general price level. But at least in some sectors where you're withdrawing private sector resources and putting them into public sector use, it could be a bit unwise to do that too fast. But the problem is, of course, a lot of Green Party politics and all that want to do it real fast. They're gonna, if they get into power, they're gonna push the button full speed ahead on some of these public infrastructure projects. And I don't care if that causes some inflation, to be honest, but it could cause some inflation in that way. But it wouldn't be a bad source of inflation. You'd be creating the supply. You'd be injecting the currency for people to buy that supply. It's just that you'd be hitting, bottlenecks in terms of, well, how many construction firms and construction workers do you have? How many people do you have to actually build the houses or build out the green energy or geothermal or whatever you got? And so you can't, like you say, you can't spend on what's not for sale. The other thing is, I guess I lost my other thought, but I did have another thought, but that'll do for now, I think. Yeah.
I think we're in agreement, Bijou, in terms of how we view velocity. So we'll
velocity is important, but acceleration really matters.
Really, yeah.
So acceleration of, I'll just say this, acceleration of like credit growth and stuff, like that makes a lot of sense to me. I just I don't really get what velocity even is.
The way that velocity entered my vocabulary, I think, is through Steve Keen lectures, and I think what Steve Keen means by velocity is the turnover of the existing money supply, that not like M2 money, but like the money supply we would understand as money supply, would be the turnover of that money supply in the economy.
You need it. And I say if you've got like a commodity or gold standard, you got $1 bill, a single dollar bill. That's all you issue because you've only got like an ounce of gold, or or a microgram of gold. So you're going to say, we're only going to issue $1 bill. Can you have an economy that operates on a single $1 bill that can convert to a microgram of gold or whatever? Fiction. So what you can do, yes, you can have a totally good economy that way. You just circulate that thing.
You just have to, exactly.
It goes through everyone's hands like so rapidly. There's like trillion transactions in the single dollar bill a day. So that's the extreme limit. That explains why velocity is important if you don't have currency injection to
which then goes back to from like a market dynamic would be if the velocity of money is increasing, that would be this turnover continues to increase. You're going to get that supports the expansion. Does it support the expansion of the credit? I guess regardless of what. Let me take that statement away for just a second. But if you do have a growing credit, I don't say bubble, but a growing credit expansion, while you're getting acceleration, if you get a deceleration without offsetting government spending, you will prick a bubble at that point. Correct? Right, Bijou. I mean, that's the dynamic. Yeah, that's the dynamic that the Minsky models show, is that if you slow down the turnover of the money in the money supply in the system, that can prick the credit bubble. So that's
because the identity that Ryan talks about is that the money supply times the velocity, which is just the turnover of money, is output times quantity. And so if you've previously, like just in the past, stimulated decent output, then the price level can stay stable with higher circulation of money. But now if you stop circulation of money somehow, whatever way you sort of want to do it, say you lower rates to zero or you impose more tax, then the spending drops off. So even though you got high economic output, yesterday or the other year, now you're not be able to sell it. So the price could be the same, the output could be the same, but the sales don't go, so the money doesn't circulate. So then what happens? The firms just, if they're still producing, they're going to produce, stuff they can't sell. So they stop producing, they lay off workers, and then that spirals downwards. Yeah, so that's the other dynamic involving velocity.
That's a good point. Yeah. Which is interesting because I think that's what ends up happening when you lower interest rates.
without the other stimulus to support.
And then it takes away the
plus savings.
And then that takes away the other stimulus, right? Like lowering the rates will actually remove the.
So you go all backwards. You go all neoclassical thinking on everyone. All this austerity is going to create a great economy. The fuck.
Well, yeah. Well, that's what I was kind of getting at with the whole thing about the reserves and how the Fed, we have ample reserves and the Fed just cranks up the rate and starts just paying out more, and so that does increase. I guess that increases the velocity.
Circulation in your bathtub. And so that's all your circulation in your bathtub, all your eddies and your whirls are all economic growth and activity. Whether it's good or bad is up to us to figure out, but it's all good economic activity in a sense. But it's dirty water. Like the credit is the dirty water as a metaphor. And the government injections are clean if you've got a non-corrupt government, right? Oh yeah, this was my last thought. Okay, so if the government is wise and they're spending on public infrastructure and that, lowering costs to firms, helping entrepreneurs, then it's all good. It's clean water going in. But they could also be like Argentina or Venezuela, and the government could also put dirty money into the system. Just cronyism and giving people money so they go out and swap it for US dollars or whatever, not creating any real economic output. That's the other way. So my last thought was, well, if there's no oil price shock coming up, because I'm now hearing it's conflicting. The Saudis maybe cut back on production, but for a good reason. But the US may be increasing production a little bit. So I can't really read the tea leaves on that one. But you talked about the political headwinds, and I'm talking about governments, being wise and injecting currency for real production to support the economy. You got an election coming up next year, right? So that could be something.
We sure do, man.
A few hedgehogs into the mix.
Yeah. We've got some great politicians running for president this year, though. So I'm sure we'll make it out great.
So that's a very unknown. I see that as a problem.
I would agree with you.
I would say this, and I forget if you guys were involved with this exchange on Twitter or not, but somebody said something to the effect of like, maybe it was Moser even, basically that like, because of the debt ceiling showdown, there were probably payments and things that the Treasury would have normally paid for that it's like a classic. I mean, it's like a CFO of a company, kind of stretching their payables a little bit. It's a working capital swing, and part of me thinks that's why Treasury's like, oh, we need to rebuild this general account really quickly because we need to spend a lot more money. So I almost wonder if, like, the back half of this year, despite all the other headwinds that we kind of talked about, could be somewhat of a boom because some of these other programs that may have been lower down the priority list, well, now we've got the green light, and Yellen can release the hound, so to speak. Just as another thought.
Dude, I'm with you, man. I think we are still so underpriced. So one of the models that I made, and by the way, too, everybody, those are available at our Patreon, patreon.com/MMT macro trader. One of the models, and we're officially calling the entire list of the entire kind of suite of models we're making. I'm going to call it the Deep MMT tool set. But one of them I have right now is just showing consistently it's effectively a fair value price of the S&P based on flows, right? That's essentially what it's trying to do, and it's like. Yeah, I mean, at this point, it's still saying we're underpriced. On top of that, and it's been saying that we're underpriced for quite some time. On top of that, like I don't know if you look at the AAII bullish bearish indicator or anything like that, but like these sentiment things, despite the run up that we've seen over the last month, 6 weeks in stocks, we're still leaning bearish sentiment overall in some of these sentiment indicators. So I'm with you, man. I like this June thing gets me a little worried with OPEX, with the tax strain hitting at the same time. But I want to be, I really only trade the S&P and I do it leveraged, and it's just a matter of how leveraged I want based on, where the flows are looking. But I still think I want to be as leveraged as possible, because I still think 4,500 by the end of the year just is and it's kind of been my target since the end of last year, kind of my mental target, based on kind of how I'm reading the technical charts. But 4,500 on the S&P seems like beyond doable, possibly higher. I mean, at this point, we're at 4,300, so at this point 4,500 seems almost inevitable. But that's been where I'm at, and I think we can maybe even push higher. I guess it's only it's not too far away, but I'm with you, man.
Putting the receipts out there again.
Yeah. Oh man, yeah. Listen, I'm gonna brag, dude. I'm gonna.
How far into this live stream is that buried?
Oh my god, yeah. You guys have seen Goodwill Hunting.
Oh, we haven't done 3 hours yet.
You guys have seen Goodwill Hunting, right?
Yeah.
Ryan, Goodwill Hunting.
Oh
man, okay.
I've only seen. I'm like cinematically illiterate.
Oh, that's
I've
okay.
Seen from it.
Okay.
But I haven't watched it.
Okay, then this is like the one scene you've probably seen, right? So the super privileged kid tries to flirt with the girl, and the girl doesn't want him, and then Matt Damon comes around, and she kind of falls for him in that moment and gives her number, and he comes back with the number on the napkin, and and then slams it to the window. Hey, you like apples? How you like them apples? And it's got her number. Some guy was like, well, show me your returns. Show me your returns. I've got great returns this year. I have alpha over the I've got alpha over the market at this point. I'm beating the market and for the year. And I almost thought about making that scribbling what my returns are for the year so far on the napkin of that scene of Matt Damon smacking it up against the window. You like apples? Yeah, man. I've got plenty of apples this year. I put my money where my mouth was.
Amazing.
But yeah, dude, I'm with you, man. And it's interesting to hear the ANG trader guy as well today on your podcast that you guys released with kind of the same thought. Like, it just seems like, and maybe it's just because we're all in the same Twitter world, and there are just so many pessimistic, like, everyone wants to be what's his face from The Big Short to find the next big thing that's going to blow the world up, and it's like, well. Actually, I know he made his money betting on the housing market, but what it really was is just the massive, almost effectively the surplus that we had for multiple years, right? That's really what caused it, and it just manifested in housing. And it's like the one thing that caused the big sell-off, the extended sell-off, just hasn't manifested at this point. And it's hard to not kind of be overly bearish, especially, or overly bullish, especially when there's still so much bearish sentiment here. Incomes continue to rise. That income has to be spent or saved. If it gets spent or saved, that's good for the S&P, no matter which way which way you cut it, as long as that income continues to flow higher. So yeah, dude, I'm with you, man. I'm holding on to the end of the year until a president gets in that says we're going to balance the budget no matter what. At which case, we'll go elsewhere, but it's
amazing to me how like people on Twitter, they're just trying to find ways to justify the stronger economy and stronger job market, and they're like, oh, it must be AI.
Yeah.
It's the AI boom.
A lot of electricity.
It's like what? Like, what do you think the AI related capex is in the last year?
What is it?
I don't know.
Not big enough to
cause this boom. Just headline watching. Yeah.
So it's pretty funny watching these mental gymnastics.
It is pretty funny.
Do.
Which, by the way, go ahead.
Go ahead.
Yeah, we're probably going to say the exact same thing. So I'll let you.
I don't know. Man. We always have an AI.
That's it. That's exactly what I was going to say. That's exactly what I was going to say. Man, Ryan, I don't know how often you make it into the third hour of our live stream if you ever listen to this deep, but third hour is always we're allowed to talk about whatever the hell we want to talk about.
AI hour.
Yeah, it's AI. I mean, recently it's been the AI hour. I'm sure at some point it'll get into it, it'll get into more fascinating subjects than than AI.
I mean,
but
it's not a deep. Yeah, I mean, I agree with Ryan that it's all a blow overblown. There's a lot of headlines, and there's a lot of whatever runways being run off the end on a lot of these tech companies, I imagine, because so many new AI products based on the large language models. How on earth are they getting any revenue? It's all got to be at the moment venture capital funded, and that can't last forever. So there's a little bit of a bubble there, but
if anything, AI should be deflationary, right? Like
it should be a productivity gain.
Okay. Like
it should be, but that'll take a while for people to sort of grok and understand.
If AI is actually effective, it means that I can be increasing my production myself.
Yeah.
Right. Not needing to hire new people because I've got my little AI army to do what I would have hired other people to do.
At least for a lot of white collar jobs and jobs that could happen. But there's a few bottlenecks there because a lot of companies, or at least that I've heard from almost firsthand, secondhand, they're not using Chat GPT and other models because they're scared of data protection issues.
Yep.
There's like market research companies, they don't want client data to get out, and there's so much of this tech stuff is just Wild West, unproven and highly insecure. So you got like this, what is it, any GPT or something, Auto GPT. You can run that on your computer and get it to go out and do use the internet to get back information, because Chat GPT, is restricted to what is it, 2021 corpus.
All
human knowledge.
August of 2021. Yeah.
So the other one, it can actually go out and search the internet, but it's making all these HTTP requests for you. You have no idea what it's actually doing.
Yeah.
Like people are running stuff, and they're freaking insane. It's like I say, they're out on the internet, having sex without condoms in a massive way, and it could really bite people once the mafiosi, internet mafia stuff gets going with all the ransomware stuff again. It's just a whole new opportunity for that as well.
Oh man, I never even thought of that. Oh yeah. God.
But the other thing is, in Bloomberg podcast, which had zero views at the time, but I don't know. Anyway, I had to listen to it. Had a guy on Jens Nordvig, I think. This is a good AI sort of a name, if you know, AI academic. Anyway, he
sounds like an AI guy.
He's doing he's doing these market. It's called I forget what the name of it. Some product. It's called Market Manager or something like that. I'm butchering it. MM to market something. Anyway, all he's doing really is doing a report. And how were they doing it? Were they using some nice, PyTorch or TensorFlow modeling to look at the fiscal flows and all that? No, not at all.
Oh yeah,
they were just mining social media data, mining social media to get ideas on where prices would move. And their key sort of secret weapon was just to clean the data, get rid of all the flood. That's all they were doing. So, anyway.
It is amazing. I've built some AI models for non like investment MMT world stuff, and it's amazing how powerful these deep learning models can be when you have really, really well labeled, really, really clean data. Stunning stuff. That is, if you get into the deep learning world, that is where you need to focus first. Make sure your data is clean. Yeah.
So I've got to get myself a better computer so I can actually run this myself, and then train it.
There it is, the CapEx cycle.
Yeah, and exactly. It kicks in some ways.
Bijou, my PC is available from midnight to 8 a.m. Man,
get my credit card out.
It's all you, my man. Get on the terminal. I still have my PC boot to Linux first.
Yeah. No, I'll
specifically
do that. Okay.
because I knew you would tunnel in, and if it ever restarted, it would go back to Linux, so you could get back in. So it's still literally set up for you.
Oh, okay. You get to tell me that. I was worried about the times again.
Midnight to 8 a.m. is all you, man.
That's your time, right?
My time, it's my time. Your daytime,
midnight to 8 a.m.
All right, man.
Right. I got a book like that.
Ryan,
the other thing, quickly, is that I'm just going to have to. I'm archiving a lot of Ralston Neral's text body of work so that I can build the sentient mind of Mosler later on. It'll just be one of those large language models with all of his stuff weighted heavily, right? So. Ralston Neral is Warren Mosler backwards, by the way.
Ty Keynes doesn't do the counter.
I say it too many times. Yeah.
Ryan, man, thanks for jumping on such short notice. What a great discussion. A lot of insight. You now have the link to get on at any time. So the invite is always there, man. If you hear something going on and you're like, dude, I got to speak to that, jump on in.
Oh, dude, you shouldn't say that. We'll get bots now.
No, well, just him. He's the only one that's got the link. 2 people have the link to get into our live stream, and both of these people.
Depends how secure their Gmail and computing is themselves. Right?
It is Ryan and Warren Mosler. So Ryan and Warren Mosler, if you're watching, anytime you want to, if you jump on in, say hi. But either way, we'll definitely have you back on in a couple months, or whatever the next big banking crisis, the banking crisis drama that you can't miss. Shocking news.
Well, Jeff, thank you for having me.
I've had a blast.
It was really fun.
Before we leave, just one more time, everybody, you can find Ryan over at Applied MMT Podcast. Again, I will show that. You guys, everyone's watching this point knows that, but just in case you've made it this far and you don't, Applied MMT Podcast, where you can find Ryan and check out what him and Adam are doing. And for our sake, patreon.com/MMT Macro Trader. That's where you can find the research. If you're an active trader, active investor, head on over there to get the research there. Otherwise, Ryan, I mean, if you got any other final thoughts, again, third hour, we talk about whatever. So if there's any last thing that you want to bring up, fire away, man. Otherwise, we can wrap things up.
No, I think I think I need to go to bed. But it's been really fun. Right. Thanks for having me. And maybe one last thing thought. We should maybe have both of you guys on the podcast again. Maybe we could talk some AI stuff. Adam has his own takes on it, and you guys seem like you have some hands-on experience with deep learning and built some AI models and stuff. So it's just that's very topical. So maybe we can that could be kind of fun.
Apparently, if you're an Apple CEO, you're not allowed to say AI now. It's got to be machine learning. Machine learning is a PC term.
Right.
You get those regulators knocking on your door.
Speaking of which, did you see Apple took out on their flagship like $12,000 machine? They took out the GPU and are just going like a 72 core CPU. I don't, unless it anyway. Anyway.
Don't know about that.
Josh,
anyway, thanks, Ryan.
Ryan, man, thanks for dropping in. Josh, we'll talk Apple Vision Pro next week. I'm interested. $3,500, a little steep even for me for an AI or for a VR headset, but we'll talk that next week. We've been having 3 hours, man. Ryan, once again, thanks a ton for joining us. It's been a great conversation, tons of insight. I think we solved every finance problem that's ever been proposed that needs to be solved. So we figured it all out. And again, I mean, this is the only place you're going to get this sort of discussion. The only place. There's no one else on the internet.
No one else there living in New York with blonde hair.
Yeah, that's about to move to Florida that's doing anything like this. No. Right here.
No.
Anyway, thanks for joining us.
We're doing an outro?
Yeah, of course. I mean, Ryan, unless you have an outro, but no, Bijou, why don't you go ahead and send us?
Yeah. Well, lots came up today. Stuff to talk about next week. But until then, good, gentle people of godly town Gotham. It's all calm now on the debt since the debt man is behind the bars in Arkham Asylum. No worries there for a while until he breaks out again. Who knows when? But I think, what's that there? A new supervillain on the loose? Shark Eye, the debt collector. Seems Shark Eye could be biting a few student legs off again starting a few months from now. Is the Mosler tried ready, or is he tied up changing diapers for a grandson Sterling? Is the Keltonator still trapped in the horrors of the Zoom rooms with the PMC types, or marking student exams, that sort of carry on? What about the Tyrone the Typhoon modeler? Is he up to rescuing the student body, or is he away skiing in the Canadian Rockies somewhere? What's that I hear? Is that the Typhoon at work in the garage building his Star Trek Rebel Force TIE fighter model? Sorry, did I say Star Trek? Or is it just the toy model? Can Ty the Typhoon go from toy to adamantium frame infused Tie-mobile gold bug particle filtered metallics to avoid the hallucinations of gold-funded Tie-mobiles? Will he be able to get to work a working Tie-mobile running in time before Shark Eye starts his villainous biting? Well, you'll never know unless you tune in next week to find out. Same MMT time, same MMT channel.
Man, a fantastic outro for a fantastic episode tonight. Thanks, everyone, for joining. We'll see you next week, everybody. Take care.
See ya.